Good morning from the BCI side and welcome to day 2 of the BCI Global Investment Conference. Really great to have all of you here again in Cape Town, and to our online viewers from our side as well. Thank you for attending. It's really great for you having to make the time and being here. To our presenters today as well, full lineup. Not as long as yesterday, but you're going to get a lot of information. Similar format to yesterday, we invited some of the top DFMs in the country to moderate our sessions. And here already on stage, you've met him yesterday, is Rafik Taylor from SMMI, or Sanlam SMMI. Good morning, Rafik. Thank you so much for being here again. And his panel joining him on SA Equity Outlook is Nick van Rensburg from All Weather Capital, Warren Riley from Batelier Capital, and Chantal Baptiste from Fairtree. Gentlemen and lady, thank you so much for being here this morning. And Rafik, I'll hand over to you. Thank you.
Thank you very much, Eugene. Good morning, everyone. It's lovely to be back on day 2. I finally get to moderate an equity panel, which I haven't been doing for the longest time. So I'm sure we can have a lot of fun. So I guess let's kick off on the presentation side. Nick, you're first up. Going to talk about China and gems and telling us whether there's opportunity or something to potentially heed, and then followed by Warren on opportunities outside of the top 40, and then Chantal to take us through what to expect in the second half of this year. So Nick, over to you.
Thank you. Okay, so I'm going to speak about China today and why is that relevant. We've got an emerging market business, and China is 27% of the index, and South Africa tends to trade quite a bit with China. When China does well, we tend to do quite well as well. And then locally, we've got Prosus and Naspers, which is about 13% of the CAP Swiss index, and those would go into the domestic funds and into the new Best Ideas Fund. So China, in our view, is quite a contrarian trade in the beginning of the year. It was very, very cheap. It is cheap on absolute terms, and it's also cheap on relative terms. And one of the key differentiators, I think, is that most people believe the Chinese government does not care about Chinese equities, and we believe that that is incorrect. And I will just run through some of the reasons why we think so. And then economically, while there's a lot of negative news about it, PMIs have started improving, which is usually quite a good time to own China, especially manufacturing PMI. And one of the ironic things about the cycle, we've got very, very high rates, and yet we've had a manufacturing recession over the last 2 years, ever since the Ukraine invasion. And that we're now starting to turn out of that, which is a time that you want to own China. And if you look domestically, the Lunar New Year travel has been very strong, and also airline travel. This is just a chart that shows EM valuations. EM is very cheap versus developed markets. It's basically at the lowest valuation it's been. And then this is China versus a very cheap EM. So this is probably the cheapest we've ever seen China. As I mentioned, obviously, sentiment is very negative, and we started picking up some indicators that things are changing from July last year. The CSRC cut stamp duties, they lowered fees, they told the insurance companies they can increase their equity holdings. Currently they're between 12 and 13%, and they can get up to 45%, if they match solvency. Now, what's interesting about that is, about 7% would buy all the foreign-owned equities in China. So this is quite a significant deal over time. They've also launched pension schemes in April last year, which they're busy rolling out, and that'll give, as anywhere else in the world, it'll give a bid to Chinese equities over time. And then 2 other things which I think is quite significant is that they told the companies to be doing more buybacks and increasing their dividends to create shareholder value, which is something that's never happened in China before. China used to be a net issuer of equities, and that's one of the reasons why the stock market did so much worse than the economy. And that's now changing. They're following what Japan's doing. And then the area in red I thought was the most significant, and that was essentially the SOEs, the state-owned entities. Management were told that they will be incentivized based on share price performance. So if you run a Chinese bank and you don't get your share price up, you're not going to get your bonus. And that is a very, kind of non-conformist thing to do in a country like China. And we think that's quite a big change. So they've also changed some of the regulatory officials that have caused, downdrafts in the stock market. And I think when we look at all of the different things happening, the housing market's obviously a very big worry. And what we noticed in January is that one of the big provinces started buying units in the secondary market. Now, normally they have to be building units, and that's why we get quite a lot of iron ore demand. And they started buying these units, which has obviously fallen very significantly. I think in time that'll be bullish for the real estate market because it'll clear some of the overhang. It'll also put liquidity into the system. And against that, it's negative for iron ore because you're not going to be building as many new units. So that's the takeaway from the housing market. Clearly, this is something we keep watching all the time. And they've put bank support for select developers. They're talking about hookah reform, which is a reform related to migrants and allowing migrants to buy property in towns. And we'll hear more about that in the third plenum. It was expected in June, it's now confirmed to be in July. So over the next 2-3 months, we'll hear further about that. And then quite a lot of work has gone into stabilizing US-China relations, and I'll speak about that a little bit later. This is one of the more interesting charts from UBS, and it basically shows that China on the far left is the most attractive country in the world to be doing share buybacks. If you've got money in the bank, it earns virtually nothing, and you can buy back companies on 10% earnings yields. So it's earnings enhancing to be doing share buybacks. Against that, if you look on the right-hand side, you'll see US and SA a little bit less attractive. That's on average. Obviously, in South Africa, there are quite a few companies for which it is attractive. And then in places like Mexico and India, it's very unattractive to be doing share buybacks. So China is the most attractive. And at the bottom, you'll see that almost 1,300 companies have announced share buybacks so far this year, and that was to the end of Feb. So that number is going to continue growing, which is a new bid in the market that didn't exist before. We all know about the AI craze. I'm sure you've discussed that at length, over time. And what you see here is a lot of this started around the time when Microsoft invested in OpenAI. And then when ChatGPT-4 launched, it really got going. So NVIDIA was up 482% since, and if you look at the Chinese shares, they're basically all still down. Now, these companies lead in AI in China, and you would have seen that Toyota's done a deal with Tencent, and Tesla's done a deal with Baidu. So they clearly have no AI premium, despite the fact that they are the leaders in AI in China. And then this is one of my favorite charts. I call it risk inequality. A lot of people would say, well, I don't want to invest in China because they're going to invade Taiwan and you're going to lose all your money. Well, you're going to lose more money in US equities than what you'll lose in Chinese equities if your benchmark is the all-country world index. I don't want to go through all the math, but basically speaking, the China exposure of Apple in the all-world index is about 2.6%, while the whole MSCI China is 2.75. So you're going to lose as much money in Apple as what you'll lose in the whole of China. And similarly, NVIDIA sources 100% of their chips from Taiwan, and you're going to lose more money in NVIDIA than what you'll lose in Taiwan. So these are the kind of things that happen over time, which to me doesn't make that much sense. The US is now 25 times the market cap of Chinese equities, even though it's only 50% larger GDP. And China is basically slightly larger than Canada, which doesn't make any sense. Alpine Macro has got a great chart on the left-hand side. It just shows that Chinese equities are basically trading where US equities were trading in the 1930s in the Great Depression. And we don't believe that China is in the Great Depression. We believe that the economy has got headwinds, but it's not in the Great Depression. And the key variable, I think, there is that there's been significant economic policy uncertainty, and that's driven the discount in Chinese equities. And what we've seen is that the messaging is becoming more consistent. So as that happens, we anticipate that Chinese equities re-rate. The housing market is the thing that most people fear the most in China, and what we'll see here is that you've got to differentiate between new homes, which the government controls pricing of, and that's a manipulated market, and then secondary homes, where you can see that there's been a steep increase because prices have fallen somewhere between 30 and 60%, depending on the city. So the housing market is stabilizing. Okay, so in summary, Global manufacturing PMIs are bottoming, and that's normally bullish for China. It's bullish for South Africa, Brazil, all the kind of commodity countries, and especially the exporting countries, of which China is the largest, and South Korea and Taiwan are similarly large. So this is quite a good environment generally for EM. EM is cheap against, developed markets. It's also cheap in absolute terms. And if we do see flows coming into EM, that'll be coming into SA. It'll also be coming into China. So the other thing which no one seems to mention is that it's the 75th anniversary of the CCP, and that is not a time when they want to be embarrassed. If you go to the East, you'll know that they don't want to lose face. On the 1st of October is the 75th anniversary, so I think they're going to do quite a bit to keep the economy strong through the third and the fourth quarter. The risks we're obviously watching the relations with China and the rest of the world, especially because they're on an export drive, the Taiwanese presidential inauguration, which is the end of this month, the real estate market, obviously. And then the kind of key issue that China needs to address is it needs to create a consumer market that's larger than consumption is too low as a percentage of GDP. They need to increase that at the expense of other things, and if they do so, that'll be beneficial. Two actions they might take at the third plenum is to do childcare and elderly care grants, which we think will be positive. And then China-US relations, I think, is going to be a little bit tough in an election year in the US because both presidential candidates are quite harsh on China. Okay, thank you.
Okay, good morning, everyone. My name is Warren Riley. I'm from Bateleur Capital, and today I'm going to talk to you a bit about the opportunities we're seeing on the local market. Firstly, a brief introduction on the business. So Bateleur was founded over 20 years ago. Today we remain a very focused business running 4 equity-centric funds where we apply the same consistent investment process. We see ourselves as largely unconstrained and are flexible when selecting equities. And I think importantly, we run around 14 billion rand today, which allows us to participate in a wider opportunity set on the JSE. And I'll talk to some of those opportunities we are currently seeing. Recently, the Financial Times issued a story entitled "The Bullish Case for South Africa." It was one of the first positive stories I've seen on the South African economy in some time. I think when you look at some of the comments made over the last day or two at this conference, there's generally an improving theme from SOEs, there's greater private sector involvement, and the outlook looks to be stabilizing in South Africa. And when I got to the comment section on that Financial Times story, is when I started to see the real sentiment towards South Africa. There were over 130 comments, all extremely negative on our prospects. I think this comment sums up that sentiment quite well. The bullish case for South Africa is eventually there's a rock bottom. And I think the data we're seeing is certainly pointing to rock bottom. So when I look at these charts from left to right, firstly, since 2016, foreigners have sold over 850 billion in South African equities, and it's been pretty much a one-way journey. At the same time, domestic investors are allocating offshore with the change in Reg 28, so they've been selling local equities. Domestic asset allocators were at around 25% allocation offshore 3 years ago. We think they're over 40% today. When you take those two forces together, you've seen a liquidity drain on the JSE. That's the last chart on the right here. Value traded at red line is now down 25% year to date. It's at a 5-year low. And what we are seeing on the JSE is that price discovery is exceptionally poor. There's limited interest in JSE-listed equities, especially SA Inc. type businesses. And as bad as it sounds, this is an environment where active managers and ourselves are finding very good opportunities. So how do we make money in this type of environment? We're finding 3 areas, and I'll talk to an example of each. A big part of the Bateleur process is focusing on cash versus accounting earnings. We think cash is a better indicator of a business's financial health and the key driver of valuations. When you look at the second option on special opportunities, These are businesses where our fundamental analysis finds mispriced or misunderstood opportunities. And then finally, on corporate action, these are businesses where we think there's a high probability of corporate action occurring, either via takeouts, breakups, and so on. So, cash versus accounting earnings. I'm going to give an example of Truworths versus Foschini Group. The chart on the left-hand side shows the free cash flow history of Truworths versus Foschini. Truworths in blue. You can see Truworths has a consistent history of free cash flow generation, while Foschini Group is much lower and volatile. We think Truworths' free cash flow history has been driven by a management team which has a strict focus on gross margins, working capital, and a strong discipline around capital allocation. I think more importantly, this chart on the right shows the picture better. So since 2010, Truworths has generated over 30 billion in free cash flow, whereas Foschini Group has only generated 12 billion. This has allowed Truworths to buy back over 12% of the company over the last 5 years, continue paying a high dividend. They pay a dividend yield of close to 9%, as well as retaining net cash on the balance sheet. On the other hand, Foschini Group had to undergo a rights issue during COVID to repair their balance sheet. They've continued to acquire businesses, most recently acquiring the Tapestry Group for 2.3 billion rand, and they still have net debt on their balance sheet of 8 billion. You would think Truworths would trade at a premium based upon purely this free cash flow picture. However, if you look on the chart on the left here, Truworths trades at a 20% discount to Foschini Group and has been that way since 2016. We think the prospects for Truworths' earnings growth looks good. We expect them to continue growing earnings and free cash flow. And another important point for the Truworths investment case is that the business is driven by the credit cycle. And you can see here, one back, you can see here that net bad debts in their credit book are elevated. And as interest rates come down, we expect that to improve. And it's been somewhat captured by the management team's recent comments where Michael Mark said the credit environment is improving and we are well positioned for the next cycle when interest rates decline. So Truworths remains a core holding in our retail exposure in our fund. On to special opportunities, ACI. We've spoken about this business a year ago. There has been progress since then. The business is a mining business, a mining explosives and chemicals business. It's internationalized with over 50% of its profits from offshore markets today. They've recently appointed a new CEO and announced a strategic restructuring during November 2023. I think what's key here is the focus is now being put back on the core business, which is mining chemicals and explosives. They're going to divest from underperforming business units, and in doing so, they aim to double profits by 2026, improve margins and returns, and reduce gearing. We think this is a very positive picture and see the probability of them executing on this reasonably high. We expect management to announce divestitures from non-core assets over the next 12 months. The local market, when I painted the picture of very little interest in South African equities and low liquidity, has not rewarded management yet for any of these restructurings. If you look at this chart on ACI, it shows you since the capital markets day over here, the share price has actually fallen over 15%. There's been limited investor interest in this restructuring. And furthermore, you've seen the rating on the business fall to around 6 times earnings. Now, ACI has 2 listed peers that trade in Australia. You can see those businesses trade on high teen multiples. So the discount between ACI and its peers has never been wider. I think this plays out in 2 ways. Either management delivers on this restructuring and the business begins to re-rate, or ACI is acquired by a global mining explosives business as the industry consolidates. And we have seen this occurring in the last 6 months globally. African Rainbow Minerals, in terms of corporate action, this is a diversified miner. It's got interests in manganese ore, iron ore, coal, and PGMs. The business also benefits from net cash on the balance sheet of almost 10 billion rand. It has a stake in Harmony Gold, which is a listed business worth 13 billion. So if you look at the market cap today of ARM, it's 44 billion, implying that those operations across manganese, iron ore, coal, and PGMs is only valued by the market at just over 21 billion rand. We think that operating assets are going to continue to generate good headline earnings, and we think the businesses, despite low commodity prices, will still earn over 6 billion rand, valuing that rump at only 3 times earnings. It's a very low relative to diversified peers listed on the JSE. I think important to point out here as well is that Assor, which owns 50% of African Rainbow Minerals, manganese and iron ore assets, was delisted by management during March 2020. It delisted at a valuation of 44 billion rand. So keep that in mind relative to the current implied value of only 21 billion. And we see similar optionality in African Rainbow Minerals, given the high cash balances and that management and insiders control 60% of the company. And on the last slide on corporate actions, I think mid-caps are a very interesting space in South Africa right now, in South African equities. We're finding businesses that have continued to grow earnings, but there's just no interest in these businesses. You've seen their ratings fall, and in many cases trading at all-time low valuations. So starting on the left-hand side, business like Impact, it's a leading integrated paper packaging business. It's more than doubled earnings since 2016, and yet its rating has fallen to only 5 times earnings at the bottom here. Adcock Ingram is the leading OTC pharma business in South Africa. It owns brands such as Panado, Carenza C, Biogen, and that business has also more than doubled earnings, and its rating has fallen to under 10 times this year's earnings. And then lastly, Italtile. This is the leading manufacturer and distributor of tiles in South Africa, as well as the retailer of sanitary ware. The business has had a good track record of earnings growth. It trades at 7 times trailing earnings. Again, the lowest it's ever traded. These businesses are all cheap, but I think also each one of these businesses has potential for corporate action. So if you look at Impact, Caxton has built just under 34% position in the business, and they've said they have intent to gain control. Adcock Ingram, Bidvest own just over 56% of the business, and you've recently seen an Indian pharma company, Natco, acquiring shares in the market. We think there's a possibility that Adcock Ingram is taken private. And then lastly, Italtile, the Ravazotti family who founded the business, control over 57% of the company. It has net cash on the balance sheet and can be easily taken private. I think final slide, just looking at the track record of the equity strategy at Bateleur. It's compounded 11.2% since inception. It's about 1.6% ahead of the market, which has delivered 9.6%. As I've shown you, we're finding many opportunities in this beaten down market. We think there's opportunity for continued alpha generation, and we're quite excited about the potential performance from the fund from these levels. Thank you very much.
Thanks, Eugene. Thank you to the BCI team for having Fairtree here this morning. Good morning to everyone. It's nice to see everyone in person and also online. I see Tanya put me last this year. I think it's because I almost missed my slots at the beginning of last year because I was late in traffic. So Tanya was here on time this morning. My name's Chantal Baptiste. I'm one of the equity portfolio managers at Fairtree. And I'm here to talk to you this morning about the second half of the year. So I think there's some key themes, and Nick as well as Warren have positioned some of our thinking from an equity perspective. But if you had asked me at the beginning of last year, 2023, do I think that the US equity markets are going to get much higher from here? I would have said it's possible, but I don't think it's probable. We have to have some type of slowdown. You can't take interest rates from 0 to 5% and nothing cracks and nothing breaks. And then we had a wobble. Remember the US regional banking crisis, and we all thought we were right. And the US market just shrugged it off and they carried on going higher and higher. At the beginning of this year, January 2024, if you asked me the same question, my response would have been the same. It's possible, but I don't think it's probable. Yet the market keeps going higher and higher. You would have seen the recent rally. So it's almost as though nothing's broken. Nothing is impaired. There are no defaults. There's no cracks in the system. It's quite an interesting concept. And I think there's a lot of FOMO in the market because you want a piece of that, especially if you're looking at emerging markets, the Chinese equity market, the South African equity market. You want some of the US action. There is lots of elections going on this year, so it's something to keep an eye on. I think about 67 countries globally go into national elections, the US being one of them. I think it will be an interesting event to watch. I don't think we can write JFK Jr. completely off. I think he is a bit of a dark horse in the race there. I'm not a political analyst, so I don't have a firm call on it. I think there's a high probability that Trump does come into power. But I think that what's important here is the system's bigger than the man. So regardless of who comes in, the US system is bigger. I think our elections are going to be far more interesting. We look at China, that's very, very important. We had such a great presentation on China. It is interesting. Looking at Chinese valuations right now, you have to have one of two thoughts in mind. It's very binary. Either China is completely uninvestable, it is broken, or this is a buying opportunity of a lifetime. Those are the only two choices. And China is interesting because if they only do marginally better than last year, it has a very, very nice effect on emerging markets, specifically commodity exporting emerging markets like South Africa. They're our biggest trade partner. If they do better this year, we do better this year, all things being equal. So I think NASPAS and Process has still got proper legs going into the second half of this year. War. There is war at the moment, and the Middle East war has escalated a little bit more than what I thought. I don't think it's in anyone's best interest to have World War III. I really don't. Well, someone will benefit along the line. Someone always does. But I don't really think the US or Israel or the Middle East really want to go into a hot war. I don't think that's the base case. So at the moment, it's more like watching two ladies handbag fights. It's aggressive, it's entertaining, but no one's going to die yet. It might escalate from here. So it's something to keep an eye on. And the trade you want to be in there is gold and oil. Those two will benefit considerably. And then lastly, I included that just because I like throwing sometimes interesting things out there. Everyone talks about AI. I think it's interesting. I think they're more of a cover band. They're not really original, but AI is interesting. I thought this is more interesting because I thought we had nailed climate change and what the ramifications will be. Climate change means you don't live by the coast. Why? Because the oceans are rising. You don't go live in New Zealand. It's a terrible place to live. You rather choose somewhere inland. That's why I live in Stellenbosch in the mountains. Yet, climate change caused my roof to blow off 2 weeks ago in that big storm. Legit, a third of my roof blew off, our ceiling fell in while we were in bed. It was quite traumatic. I'm sure one day I'll look back with fond memories and it will be a funny story to tell, but at the time it was very traumatic. So what are the short-term insurance companies going to do about this? Because it's not just the coast anymore, it's also Stellenbosch. It also, with the wind that came through, caused a fire. We had Blauklippen Manor House burned down. Santam insures that, just as a side bit of interest. So what are the short-term insurance companies going to be doing about this? Because it's not going to dissipate. It's only going to come more and more. You saw the flooding in Dubai. Who would have thought that Dubai would have over 140 mils of rain in one day? It's absurd. When I saw the videos, I thought it was fake news. So it's just interesting to think how they're going to navigate that, and also how do the reinsurance companies try and navigate that. If we look at, this is the first quarter because I know I'm looking out to the second half of the year, but this has already come and gone. And again, that's that FOMO trade there. So that's the Magnificent Seven. That's where you really want to be. And what is funding that trade at the moment? It's emerging markets and specifically Chinese equities. The US doesn't want to touch China. They're all piling into their own market. So it's just going higher and higher. It's very, very interesting. And then on the other side, just from a commodities perspective, we've seen Bitcoin take off. I heard last night there was a lot of action around Bitcoin and big announcements, but nonetheless, very interesting thing to watch. Oil, another really, really interesting thing to watch. And you can see, as Nick pointed out down here, iron ore, not a real benefactor. But this surprises me. Does it go higher from here? Is there something we're missing? Does the US market just continue to go higher? Because there's no signs of cracks. The US consumer is spending. They're in a good position. There are more job openings than people seeking jobs. My question is, how long does it last? And obviously then the next thing is, when do we actually start to cut interest rates? We were meant to have 6, it's dwindled down to 1. How does that impact the South African market? Because our SARB will wait for the US to make a move. We look at the Middle East, just looking at that war mention that I made. This is a really neat decision tree that BCI publishes. At the beginning of the year, we were sitting more across this side, so a little bit more of the green was factored in. And right now, unfortunately, a few heads are in the way here, but I'm sure you'll get the presentation afterwards. We're down here, 60%. US limits military involvement. They're not acting yet. It's that handbag fighting. But what happens if they do? What happens if Iran steps in more? What happens when Saudi has to make a call on this? I'm not calling for World War III, don't get me wrong. I'm just monitoring it because we're looking into the second half of the year. And how do you play this? Oil is going to be interesting. These are the producers of oil. These are the gatekeepers of energy. I know you want to talk about renewable, but energy is by and large fossil fuel today. And these are the gatekeepers. The Middle East accounts for a third of oil production globally. That's huge. What happens if we go into some type of World War III? Who do you think Russia and China side with if they have to choose a side? Do they go with the US and Israel, or do they go with their friends in the Middle East? If they do, that's 50% of world oil production. It's huge. It's really, really significant. So oil's quite an interesting one to keep an eye on because it is something that you can really turn the taps off. And what that also does is it messes up the US going into an election. If you turn the taps off on oil, what happens? Goods inflation starts to go up. What happens? It causes a recession. Do you win a US election in a year of recession? The Biden administration do not want this war to go through. So it's just these interesting concepts to keep thinking about. Gold is something that I would keep in the portfolio. We've traded it very well. Gold has been one of the best performing sectors on the JSE globally over the course of last year going into this year, but you do need to trade the equities. We're seeing central banks also buying into gold now, and we're starting to see it as an alternative store of value. Anecdotally, we're hearing a lot of Chinese people, because they've lost so much money in the property market, they're not playing the equity market, but they're going into gold. It's a store of value. So I think it's got legs on the trade. Even though it's sitting at 2.3, 2.4 sometimes, I still think you can play this going into the second half of the year. China is interesting. And I think that the bifurcation just looks absolutely nuts at the moment. The orange line there is the NASDAQ, and the black line there is Tencent. It has recovered. We've seen a little bit of recovery over the last 2 weeks. That's just because of favorable macro data coming out of China. But I still think it's nuts. Tencent is a real company making real cash earnings, and it's trading at a significant discount to its US counterpart. So again, you've got to look at this graph and think to yourself, China is uninvestable, or this is the buying opportunity of a lifetime. If we quickly stem back into South Africa, because it is important, and I think that Warren did a fantastic job of explaining how negative it is. Lots of numbers on here, you can go through it in your own time. This is our own forecast from an energy supply perspective. And I would have stood up here last year and I would have said to you guys that I think 2023 is going to be the worst year from a load shedding perspective. And it was. We had on average about 6 gigs of mismatch, meaning stage 6 on average during the course of last year. This year has been better. Bear in mind, we are building up to an election, so you're not going to see much load shedding before the 29th of May. After that, the 30th of May, you probably will have extensive load shedding. But nonetheless, it will be a better year, not because of that, because of what the private sector is doing. Infrastructure is improving in this country, not because of what the government's doing. It's what the private sector is doing. The next thing we need to talk about is Transnet, because that is a major disaster, and we need to improve this. This is the revenue that the mining sector in South Africa has lost over the last few years because of rail. I'm not talking ports here, I'm just talking rail. And you can see at the top here, 56 billion rand in revenue lost. The sad thing is it's not just shareholders that lose that money. It's not just the private sector that loses that money. The government loses that money because it's 56 billion rand less in revenue, less taxes, less royalties. We need to improve this. And then the next thing we need to improve is water. That is the next crisis that we're going to face. But I have confidence and faith that the private sector will again be able to step in. So I do think we're moving in a better direction. The elections I'll touch on. because it's interesting. And again, like I said, I'm not a political analyst. You would have seen the Ipsos results come out over the weekend. The market rallied a little bit into that because it looks as though the ANC has lost a little bit more ground. I saw news flow this morning on the MK. Apparently the party is trying to remove Jacob Zuma. So it's going to be noisy. It's going to be quite entertaining. I don't know what the final outcome is going to be, but I do think the ANC will get below 50%. 45 to 48% would probably be my base case. I'm not in the 40% camp. I think that's too extreme. The ANC will do better building up into elections. But there's two things I want to leave you with that's more important than the actual elections. The first thing is the ANC getting below 50% means we have a free and fair election. We still have an independent electoral commission. That is important. We are not Zimbabwe. Every election is rigged. Okay. Base case, guys, you need to understand that. Sweden, Australia, the US, there's always a bit of rigging, okay? That's just a normal election. But rigging this would be the ANC coming out with 70% type of win. We still have a free, independent election. That's very important. And secondly, the man on the street is unhappy with the ruling party if they drop below that. Also, these other parties that are coming up, Rise and Mzansi, Bosso, the other one, Action SA. Where's this coming from? It's coming from the fact that 95% of South Africans wake up every morning and they want to do a bit better. They want their children to go to school. They want healthcare services. They want to have a hot shower. We are conservative at nature. We are in the middle, okay? We're not extreme. It's why 95% of us, of our population, regardless of what your position is, will vote for a centric, black-run party. And that's exactly these new sprouts of political parties coming through. It's because that's what the man on the street wants. That's what the average South African wants. The ANC is too corrupt. The DA, unfortunately, is far too white. And the EFF is just way too noisy. We are not that noisy, okay? We are centric. We want a well-led party with far less corruption. There'll always be corruption, but far less corruption that can give us service delivery. And then just demonstrating how we've moved the fund around. So going into the last bits of the year, or the second half of the year, we're seeing opportunity in commodities, specifically in energy. I think oil is going to be interesting. Gold is going to be interesting. We're starting to position a little bit more into SA Inc. because those valuations, as Warren pointed out, are absolutely nuts. They're nuts. But we are cognizant of liquidity, so we're not leaning in too much right now, and we still have some defense in the portfolio, and that's just in case we get some type of crazy outbreak from a war perspective, and we want to fund other opportunities. But I do think it will be a very interesting second half of the year, and hopefully you guys enjoyed that.
Thank you all three very much excuse me, for your presentations. I thought there was a lot in it and a lot of talking points for us over the next while. I mean, if we start at kind of the bare bones of how our audience allocates to risk assets and to say equities in particular. Chantal, maybe, I know you just finished the presentation, but maybe just kick us off around the JSE and the fact that, I mean, I think we all know very well, if not through our clients giving us a hard time, certainly us living through a situation where SA equities has underperformed relative to their global counterparts. I mean, the all share in the last 10 years did 8%, MSCI did 16%. This is all in rands. MSCI EMs slightly outperformed that by 9.2, and then all that while inflation's running at 5, and then the prior 10 years to that, the all share index did 21%. And the MSCI World did 10.5. Again, all while inflation was sort of tempered at 5.3. So I guess we could give a round of applause to the Reserve Bank for keeping inflation stuck at about at 5%. But you know, if this looks, it seems, I mean, if you put the picture together, it seems like there's this potential for mean reversion in the SA story. And again, given the conversations we've been having in the present and the the stuff that you presented specifically on the valuation and how cheap SA is there this potential for mean reversion in SA assets for the next 10 years? What can we all expect from SA assets over the next 10?
It's an excellent question, and I wish I knew the answer to it. I wish I was a
You can take your
fortune
crystal
teller.
ball out of your bag at any point.
But I think it's important to also understand different periods. So the 10 years prior to that you're referring to, that's when we had a commodity super cycle in China. So as I stated, China's important, and they're much bigger than they were in the early 2000s. When they do well, when they are consuming, when they are building, it doesn't necessarily have to be property. They're building out a lot of energy at the moment. But it's very, very beneficial for South Africa. They consume what we produce. So in that type of environment, if you look wider than just the JSE, you'd have to say, is China going to do better over the next 10 years, or are they going to do worse? If they're going to do better, then you definitely want to be in the JSE and other emerging markets. Also, don't think it's just the JSE that hasn't performed well. I think it's most emerging markets, and it's also relative to these very frothy US markets. Your comparison is just nuts, you know, the US markets, and it's not the whole US market. It's a fraction of the US market that has done very, very well. There are also parts of the US market, the NASDAQ as well as the S&P, that haven't done that well. And my last point would probably be that's why you should back an active asset manager that knows what they're doing. Because if you're just tracking the market, that's what you're going to get. If you invested in an active asset manager that knows how to allocate capital, they can see the neat opportunities. In the PGM cycle, for example, during 2018 to 2021, you could have made a lot of money. Last year, investing in gold, you could have made a lot of money. That's the JSE. But if you're an active asset manager, you could have seen those alpha opportunities and given your clients much more than just the index return.
Got you. So, I mean, I'm happy for Warren or Nick to chip in on that conversation.
Yeah, I mean, I showed the valuations and how low they are, and the sentiment obviously is super weak. I think in the short term, if you get any positive outcomes with the election and obviously some improvements in delivery from the state entities and so on, you can have a crack-up market where your valuations go from 5 to an 8p, and just alone on that, you get kind of 20-30% returns, just purely from a re-rating. I think longer term, to your question on the next 10 years, I mean, South Africa's got a growth problem. So GDP per capita has been in decline for the better part of 10 years. We need to reform quicker. We need to be growing as an emerging economy at 4 to 5% a year, not 1% where we're currently growing. And ultimately, earnings, equity and earnings, equities follow earnings. And I mean, that's what we need to do. If we don't reform and change and get the economy growing, I think SA equities will have their time in the sun in the short term, but longer term, it's going to be, as Chantal described, much more of a trading kind of beta market where one has to be very active, and rather than a market where it's trending and growing like it did kind of in the early 2000s when the country was growing strongly. Yeah.
Okay. If I can add, the US was about 40% of the world equity market in 2009. It's now 63, 64%. And if you look at it today, if we have another crisis in the US, the people that own almost 2/3 of US equities are people over the age of 60. So it's the baby boomers aged 60 to 78, and then the silent generation, which is ahead of them. So that's who owns the bulk of US equities, and then another quarter is owned by foreigners. And that is also a peak, similar to what it was in the dot-com bubble. So we've got peak foreign ownership and peak ownership by people that are into retirement. So the odds that US equities will repeat what it's done over the last 15 years, I believe, is extremely low, just because you're going to get net supply rather than net demand. And that's one of the reasons why the labor market's tight. You've got more people retiring. The baby boomers are a larger cohort than previous cohorts. So that's one element on the US side. And I mean, you could argue that, is it really truly diversified to own 63% of your portfolio in one country? Now, I think geopolitical or political risk in the US is significantly understated. Americans own more guns than the second largest country, Yemen, which is in the civil war. They own more than twice the amount of guns. And that is very much situated amongst Republicans. So if anything happens that Republicans lose the election, I think you're going to see political risks that are unfathomable to people today. because the division in America is very, very high. So then you'll see political risk premium, which doesn't exist. If you say that to most people today, they think you're nuts. But I mean, those are kind of some of the basic elements I think one would consider. And then against that, you've got, the US is 26% of global GDP and it's got 63% of market cap. The rest of the world is 74% of GDP and it's got 37% of the market cap. And I think over time, that probably won't last. So this whole move that has been going into the US will probably come to some kind of end sometime this decade and then reverse going back the other way again. And if you go through history, it goes through these long cycles. It feels to me like this has been quite an extended cycle, and if that changes, then money flows the other way. And you're going from the deepest most liquid market into then less liquid markets, which could go up much more than what the deep liquid market could go down. So maybe Apple falls 1%, but the rest of us go by 3%, that type of thing. And then out of an SA point of view, obviously, is the market's very under-owned. I'd say the Reg 28 damage has mostly been done. Most funds are around 45%. That was a very significant outflow out of SA. We estimated at the time it will be between 5 and 11% of SA GDP, which is very significant. I think because of the significant damage it did to the rand, the numbers may be closer to 5% of GDP, but that's mostly done. So you get to the point where it becomes a shock absorber. If the rand now significantly weakens, people will be repatriating money. And we actually saw the first repatriations in April from people who took it out a year ago in April when we hit the stage 8 load shedding and the Lady R and all those kind of events. And then if SA positions itself a little bit more neutral in a multipolar world, I think we could benefit quite significantly. At the moment, we're leaning a little bit too much towards the Russian side, but I mean, if we made it more neutral, I think that could be very beneficial. Countries like India benefit a lot from being neutral in a multipolar world. Right. And that's the other element that's not taken into account in US valuations. We're not in a unipolar world, we're in a multipolar world with different poles. And if you're in the center, you can benefit because both sides are trying to curry favor.
So maybe just latching onto the topic or the theme around the SA story is linked to the fortunes of an outcome or two outcomes, maybe the US but say this Chinese story in particular and gems. If we as allocators of capital are thinking about increasing risky asset exposure and considering exposure to gems or China in particular, is that not like almost like a geared position when you look at your SA exposure versus say your additional exposure to gems and China, considering the correlation around those as risky assets, and maybe not a separate decision for owning South African equities versus say offshore equities when you go offshore, but then going into equities that tend to be sort of geared towards a similar sort of scenario as South African equities would necessarily be attuned to in terms of the outcome that it would be delivering?
Yeah, so I think that is definitely a risk to consider. If you look at valuations though, in the 37%, it's significantly lower than in the 63, the US 63. So out of a valuation point of view, I think it makes sense to be shifting to the 37. Then the second thing is the world is going through a capex cycle, which we haven't seen in a long time. We all traded China in the early 2000s, but the whole world is going through an energy revolution. A lot of what's kept the US economy up is government, through the CHIPS Act and the Infrastructure Act and all these different type of things. So that is the one element which is different in this economic cycle from previous economic cycles. The government didn't participate in previous cycles. It was all about rates and the consumer and businesses cutting back capex. But what's happened now is it kind of devolved because people have to change. If you look at South Africa, we're not meant to be in a capex cycle. Our interest rates are too high. But we are putting in solar left, right, and center. We investing, trying to turn around Transnet and Eskom and all these kind of things. It's not by choice. And I think that's something that's happening around the world across different forms of energy. So I don't foresee that that's going to change anytime soon. And that is a capital heavy cycle, not a capital light cycle. So people are investing as if we're still in the capital light cycle, which is what benefited the US. But even if you look, I don't know if you saw Meta fell quite a lot the other day because it's going to spend quite a lot more capex putting in very large data centers for AI. It's becoming a capital heavy business. It's not the capital light business it used to be. And that's, again, not a choice. It has to do it to compete in AI. So all this forced capex is indirectly beneficial to the rest of the world because we supply the commodities that goes to China, to the US and elsewhere.
Chantal and Warren, you can chip in here because, I mean, as allocators, when we think about risky assets, we're always thinking about SA equities, offshore, foreign, global developed market equities, global emerging market equities, and the EM versus SA, just the link between the two, how we should be think about those when we allocating across those risky assets.
Go for it.
Yeah, look, I run an SA equity fund, so we are exposed to South Africa, and then if you look at the makeup of the index, we already have an inherently large exposure to China. Naspers, Prosus, the miners, Richmond, you probably know the number off your head, it's probably 30-40% of the index. So when we run also multi-strategy or multi-asset funds at Bateleur, our flexible fund where we have offshore exposure, and what we seek to do is find differentiated exposures to diversify the risk in the portfolio. So we won't go seek additional EM or China exposure on top of what we already can pick up in the SA market.
Okay.
So we'll look to find like the likes of Novo Nordisk developing a weight loss drug globally who has a big runway of growth, and there's only two ways to play that theme, Eli Lilly or Novo. So that kind of thing, rather than going into China and buying a Chinese consumer play and adding to the kind of China risk.
Got you.
Yeah.
Chantal, you want to add to that?
No.
Okay. Yeah, I mean, thinking about the second half of the year, and you crystallized the fact that there's a hell of a lot of uncertainty. Do you think come second time around that a potential sort of Donald Trump victory and getting a second term is going to sort of throw the market, and B, the direction of the outcome, which again the market also got wrong back when he first came into presidency? What are your thoughts around that? And overlaying that plus the expectation that the markets, including ourselves, are expecting interest rates to come off. What do you think is kind of the potential on that front, and how does that play into your view?
So I'm going to answer the first question,
Sure.
the second question first, because like I said, I'm not a political analyst. I'd rather look at the fundamentals. I think we asked the question wrong. We keep asking, when will they cut interest rates? The question has to be, why will they cut interest rates? That's what you have to look at.
Yep.
The Fed wears two caps. The one is to keep inflation down, like Letsetja does, the SARB, but he has a second cap. He has to enforce growth. He has to make sure that the economy is growing. He will only cut interest rates if he thinks that inflation is starting to go up again. And he's also going to cut interest rates, more importantly, when he can see that there's a recession coming or there's a massive slowdown from a growth perspective. Those things aren't happening. So inflation is coming down. Him hiking rates to 5%, he could argue that he's done the right job. Inflation is coming down.
Yeah.
It started to peak its head up a little bit again, but it has on average come down. Plus the economy is growing. He doesn't have to cut interest rates right now. I also think that the world needs to evolve and realize we are probably going to be operating in a much higher, structurally higher interest rate environment or inflation environment, meaning higher interest rates for longer. I'm not saying double digits, I'm just saying higher for longer. We went through 3 decades of ultra low inflation, zero inflation, for lack of better words. There are certain things in play that I think will take a lot longer time to pan out. So I don't see us dropping to that 2% and holding it there into perpetuity. It might come down to 3%, but I think it's going to keep lifting its head again. And it's also because we've broken down globalization. We are de-globalizing now. That comes with a lot of inflationary force. The whole energy crisis, with oil also potentially kicking, that comes with a lot of inflationary force. I think that there's a high probability that Trump does take the election. I think you'll probably only be able to call it just before. Everyone's monitoring it. What I would say though is regardless of whether it's Biden or Trump, I don't think that either of them will stand their second term. I think Biden won't make it. I think he's too old. And I think that Trump will get taken out. I think he'll get assassinated. So that's my base case.
Wow. We are at a time, but maybe just one stock in terms of hot or not, and I'll go across you one stock. Let's go Naspers Process, hot or not?
Hot.
Chantal?
Hot.
Hot.
Hot. Okay, thank you so much. I know that it was quick. So from our side, I hope you enjoyed that, and I certainly hope you enjoyed the Trump assassination comment. You can catch Chantal afterwards. But yeah, from our side, thank you so much. Yeah, to you all, and thank you, my panelists.
Thank you. Thanks so much.
Thank you.
I think Chantal, Warren, Nick, thank you so much. It was a really good session, and as I mentioned in my opening yesterday, we are going to see some fundamental truths as well. I don't know about the Trump statement, but we'll park that. Chantal, thank you for that. Interesting. Right, coming up to the front now, here to moderate our session on a local fixed income, Tuvonga Shivize, Chief Investment Officer from Apex Investment Consulting. You can all come through, that's fine. Sydney McKinnon from Cadus Asset Management, JP Duplessis from Methodical Investment Management, Brandon Quinn from Saffron Wealth, and Melanie Stockett from Laurium Capital. Yeah, they're all here. Brandon, JP, Sydney, and Melanie, and Tav, thank you very much.
Cool. Cool, man. Okay, you can reach yours. Okay, man. Cool.
Thank you, Tav. I'll hand over to you.
Awesome. Good morning, everyone. We're going to kick off, I think, with the 4 different fixed income specialists we have here. So I have roughly 20 years experience in the industry. And I know that my 4 panelists are 20 plus without being very specific. So I think, Sydney, you're probably going to start. And I think as you sort of start your presentation, what is the one thing in the 20 plus years that's kind of always nagging you in the back of your mind concerning fixed income?
Yeah, I think you put me on the spot.
Yes.
Yeah,
you can also take your...
Is it the donuts I eat today, am I going to wear them tomorrow? That nags a lot.
Okay.
But yeah, Tavanga, it's probably 2 things.
Okay.
The one thing is always risk. So what are you doing about risk in the fixed income and markets?
Sure.
And then managing expectations, because I always say I don't manage money. I manage those things.
Okay.
If I can meet your expectation within the risk parameters that have been set, then I think we're a long way there. So those probably are the 2 things that nag at me every day.
Awesome, awesome.
Thank you.
Thank you.
Okay, thanks, Tavanga, and thank you. I'm just standing a little closer because of my eyes so that I can see things a little better. But I'm here to talk about fixed income and fixed income dynamics. But I've labeled my presentation today the path of totality. And some of us may know what this is, but there's a phenomenon that occurs more often than we think, where the moon moves between the earth and the sun, and it obscures the view of the sun. So it casts the shadow on the moon, more commonly known as a solar eclipse. And what happens with a solar eclipse is that, well, either you're partially obscured or totally obscured. And if you're totally obscured in that shadow, it's called the path of totality. But they say that strange things happen. Besides the darkness, the temperature drops, there's change in wind speed. They say that animals become confused, and also radio waves, I believe, get scrambled, and some even say it's a spiritual experience. But it got me thinking that in today's, and we heard a lot of it this morning already, at the moment there's strange things happening in our market, and it sort of made me think that we're kind of in this path of totality at the moment. And if we first just go abroad and we look at the risk, as I just said to Tavanga now, these are the things that keep me awake at the moment. In our game, we largely think that economic fundamentals should be the biggest risks whether it's inflation or growth or whatever the case may be, that those should be the biggest risk. But if you look at the survey that was done by the IMF earlier this year, they talk about things like misinformation and extreme weather events and societal polarization. These are at the top of the risk spectrum, and the economic stuff come a little lower down. So it's a strange thing that's happening at the moment. I'm not saying that economic fundamentals aren't important. I think they are absolutely important, and they drive interest rates, because at the end of the day, the fixed income environment is all about interest rates and the direction that interest rates are taking, and whether you can position yourself for that directional movement that's taken. But nevertheless, it's just strange that those are a little bit further down the pecking order when it comes to risk. But nevertheless, moving abroad, I'm going to touch on a few of the factors that are driving interest rates at the moment and that direction. And obviously the one big fundamental is growth. And at the beginning of the year, we had the IMF say that global growth will be about 3.1%. And now when they did the numbers again in April, they said, no, it's going to be 3.2%. But I think the important thing here is that the resilience we've seen in the growth is all good and well, but it's been uneven. And that's the strange thing here. You know, the developed economies are growing at about 1.7, just over 1%, but the emerging economies are growing at a much higher rate. So, you know, it's all good and well just to average things out, but we got to realize that the strange little thing here is that there's unevenness in the growth that's happening. So even though they're predicting 3.2 for the next year or two, we've got this unevenness. And growth theoretically should keep, or low growth should keep a lid on yields. But we've also been seeing, you can look at the US market, for example, the 10-year, we've seen yields elevating over the last couple of years. So, you know, and I think that the other thing that I want to mention about growth, besides the fact that inflation is starting to trend down, and that the gloomy predictions didn't come true, is that the pace of the expansion has been quite low or slow. And that's because of the high borrowing costs that we've had, and we've coming out of COVID, we all know, unwinding those supply chain disruptions that we've had, and then the wars were spoken about, Chantal spoke about that earlier on, and weak productivity growth that we've been seeing, and of course the fragmentation in the geo-economic environment. So these are all contributing factors that are a little bit strange, a little bit weird, but it's happening at the moment, which kind of makes me think we're still in that path of totality. And then of course there's global inflation, and it's projected to decline. But I think what I just want to say is that one has just got to be careful about how you look at inflation, because once again here, if you average everything out and you just take average numbers, one has got to be careful of the mathematics, then you don't see what's happening underlying, because the low-income countries, you actually have inflation rising or higher inflation expectation than your developed economies. So if you smooth everything out, it looks like it's all coming down. But we have countries like, okay, Argentina and Turkey are extremes, but we've still got India and Mexico that are experiencing these higher inflation expectations, whereas the developed countries, we can very well see that things are on the downtrend. And then, of course, monetary policy globally is fairly important at the moment. And we've seen that global economic, the downturn is caused by a sharp rise in the policy rates since COVID. But it hasn't really, I think it's only starting to take effect right now. And I think with inflation expectations falling, we've also got economies or countries where the nominal rates haven't really been changed yet. So that differential between the nominal rates and inflation causes quite a high real policy rate. And with higher real policy rates, your cost of borrowing and the like also goes up. So you've got this little strange phenomena that's happening, and we're all waiting when it's going to happen. We've all had lots of speculation. Is it this year? Is it later this year? When are central bankers going to make the decision to actually bring rates down? So we're kind of sitting in that shadow of the moon at the moment, waiting for the sun to come out. And if we bring things closer to home, our GDP as well. Okay, I don't think it's that strange for us anymore. We've kind of become immune to this thing because we've experiencing weak growth. And the weak growth has been underpinned by things like load shedding, 40 days and 40 nights. I don't know, it sounds almost biblical, but that we've had lights now. But let's see what happens after the elections. We've had our transport network also battling. We've had low business confidence, low consumer confidence, all the like. So even though those are strange things that are happening, it's not, we're a little bit immune to it. So, but theoretically, once again, this should keep a lid on yields. But have a look at our bond market and you'll see that our yields are actually elevated. So we have some strange things happening at the moment. Inflation is very topical at the moment as well. And we also say, right, inflation is coming down, but just it's in the mathematics because we all look at inflation on a year-on-year basis. So if you have a very high month of inflation, and naturally then the number trends lower. And if you have a low month of inflation, then it's maybe a little bit higher, as we've seen in recent prints of inflation. And we've had things that influence inflation, such as petrol, the petrol price and the oil price and food inflation. We've seen all of these things causing a bit of volatility. What I'm trying to say is that because inflation and expected inflation is embedded in the yields to maturity, especially of bonds, expect a bit of volatility and elevation as we move forward. All right, and then just a word on our currency, because this is also a fundamental that drives interest rates. Once again, our rand, one of the most liquid currencies in the world, and it's also one of the most volatile currencies as far as emerging markets is concerned. We've got one of the most highest, or the highest, one of the highest implied volatility rates. But what is strange here is that we are also playing the waiting game. We're waiting for the central banks across the world. We're waiting to see what happens with major dominating currencies. Chantal said earlier on that we won't move unless the US moves. So there's a bit of a chess game happening at the moment. And you know, I can fill the screen, which I've done. I'm not going to go through all the points, but there's a lot of event risk sitting in our currency, and whether that was, and this is just the year's worth, whether that's load shedding or whether the SARB hiked rates, or we had the Lady R story, and we have China and all the like. There's lots of event risk that permeates into our currency very, very quickly. And the next one is our elections. But you know, maybe we can chat a little bit more about elections later. But I do believe that it's an event risk, and you've got to actually look through those elections as to what's going to happen when the sun comes out again and the eclipse is all over and done. Local monetary policy, it's been spoken about this morning already. The SARB is quite adamant that they will not move on rates until they see inflation coming under control, and the risk is to the upside. We all know these things. And so we have this situation where we're sitting in this path of totality, waiting for the US to move, for the SARB to be convinced, for the Monetary Policy Committee to be convinced that a decision should be made. Just one word on quite an important phenomenon in our fixed income environment, that is credit and credit spreads, because that's become quite important in our lives, both on the fixed side and the floating side. We've seen the listed market actually, those spreads compress quite a bit, and the search for yield has become quite dramatic at the moment. So everybody's looking for that little bit of yield. So that is compressed yields, whereas under normal circumstances, those yields probably should have been a little bit more wider. And then, of course, we have elevated yields on our yield curve. The steepness of our yield curve is persisting, and I think that's because we're waiting for the decision to be made in terms of the central bankers and rate cuts to be deployed, and that's why we're seeing this elevation in our yield curve. So, and then there's a few other little strange things that's happening as well. It looks like they might not have to issue as many bonds as they've done in the past or in the recent past, because they've managed to do things like getting foreign loans in. I think the Canadian government has helped out as well. So the issuance is actually not going to be as much, and that, of course, creates a situation where there's less supply in the market, and that actually might be very positive for our bond yields going forward. Okay, just to wrap things up, though, I think another phenomenon that we've seen is that that holdings within our market, we've spoken about the foreign holdings, but it's also interesting to see that our unit trust market has actually taken up a big share of our fixed income and bond market. So there's takers out there, even though we have a strange environment. Lastly, just to point out that in terms of a process, I think it's important our investment process is saying at the moment, and it's reflecting this situation where we have a a situation where we kind of in that path of totality. There's no strong conviction, and that's shown by the bars on the chart. Bars below the line mean less conviction, and bars above mean a bit more bullish. So we're waiting for the strong signals to happen. And that's reflected within our fund. We have a flagship fund, which is our enhanced income fund. And as I mentioned that when I started this presentation, we want to be in that top left-hand quadrant where we want to give you as much return for as little risk as possible. So I'll challenge you to go and have a look at this fund because it espouses the investment process that we deliver. So that's my story this morning. If I can leave you with a final thought that if the sun and the moon cast a shadow on the earth, it's just a passing phase, and I'm sure the sun will shine again in our markets. Thank you.
Thank you, Sydney. Up next.
What is most different about this year? So I suppose, as Sydney answered, what keeps me awake at night, what do I think about the most as I'm trying to go to sleep? And I suppose, we were always taught that the most dangerous words in managing money are the 5 words. This time, it's different. And I think we've been faced with a lot of that this year and last year. If we have a look at forecasts. So Sid was showing quite a few economic forecasts and inflation forecasts, but if you had to have a look at the dispersion across different economists, you've got wide differentials between what people think growth is going to be, not even next year, but the end of this year, and inflation, and all of these huge, big variables and drivers. And so we think a lot about what's different this time, and has something broken, has something changed? And I think what's really changed this time is we haven't had a pandemic in the time that we've been managing money. So a lot of these forces are being driven from the huge shock of the pandemic and then the post-pandemic recovery. And we have to tease out all of those, how they're important and how they might or might not evolve differently this time to previous cycles. So, but that's a great presentation all by itself. So I'll save that for another day. Thank you so much to BCI for the opportunity to present to you today. What I wanted to do was, I always find it's quite useful at turning points in the interest rate cycle to take a step back and think about what lessons we've learned in this cycle. And the first one I'd like to touch on is that the market is not always right. Okay, we know that. But one example here would be we've graphed the SA repo interest rates, so South African interest rates in grey, and then the forward rate, the 21 by 24 forward rate in red. And that's really just a market predicted rate of where 3-month interest rates will be in 2 years' time. And all you can see from this chart is that it's kind of all over the place. Sometimes it gets it right, sometimes it gets it wrong. But we as fixed income managers, we, particularly in interest rate hiking cycles, get offered the gift of term premium or risk premium, which means that we don't necessarily have to have a perfect crystal ball to determine point by point what the actual forecast of interest rates might be over the cycle. We can take advantage of risk premium as and when we think that they're elevated. And how do we do that? Within multi-asset income funds, and I'm here today representing the Laurium BCI Strategic Income Fund, we have the benefit of being able to stretch our legs a bit more than money market funds. We can take some term risk into the portfolio within defined risk constraints, of course. And here I've shown some very simple instruments. So we've got a range of fixed rate NCDs, 1 year, 3 year, 4 year, 5 year. We've got the fixed rate short dated government bond, the 186, which matures in 2026. And I've graphed all of these in this cycle relative to actual interest rate, which is the dark line at the bottom. And what you can see here is that we've been able to, at many points in the cycle, lock into really attractive fixed rates between 9 to 10%, even though we didn't think interest rates were ever going to get to that level. If we've peaked now and we think we have, we're still far off that. But we've been able to harness or lock into that term premium that's been on offer within a well-diversified portfolio, particularly into events of risk-off, whether they're being globally or domestically induced. The second lesson I'd like to discuss is that yield really matters for fixed income returns. And to illustrate that, what we've shown you here is the all bond index yield going all the way back to 2009. So not a specific bond, but the index as a whole, the yield on that. And you can see that that's kind of moved around over time, but there've been specific periods or episodes of risk off where you've seen those yields rise quite considerably, or a bond bear market, if you will. Just briefly touching on those, during the GFC, we saw risk off, we saw emerging market bonds sell off, including our own, and the yield on the All Bond Index rose 160 basis points from 7.4% to 9%, so shifted higher. We then had the taper tantrum in 2013 and 14, where global bond yields rose, we rose alongside with them, and we saw yields on the Orbi rise 180 basis points from 7.2% all the way to 9%. A little bit later, we had Nanny-gate. We all remember exactly where we were when Nanny-gate happened. We had a large rise in yields, 2.2%, from 7.8% to 10%. We then had the COVID period, emerging market risk-off environment, global bond yields, emerging market bond yields rose. Anything that had risk attached to it was weak. We were a net beneficiary, if you want to call it that, into that environment. And yields rose 1.8%, so shifted higher by 1.8. And then the most recent global bond sell-off, where yields shifted higher on the Orbi by 1.7% to 12.2% yield. And if we then take the All Bond Index, the rolling 12-month return over those periods of time, all the way back to 2009, you can see, this is a rolling 12-month basis, that every time we had these large shifts in the curve, higher, yields moved higher, the Orbi 12-month rolling return dipped into negative territory every single time, except, interestingly, in this last cycle, where even though we had a very similar rise in yields, Orbi total returns never dipped into that negative area. So why would that be the case? Now, if we think about the total return calculation for either an individual bond or for an index as a whole, there are two components to that calculation. There is a yield component, so you know at the beginning of your measurement period what your yield component is going to contribute. What you don't know is the capital return. So if yields rallied a little bit, you had a capital gain, you could add the capital gain to your income yield. But if yields shift higher, which is what we've been discussing today, you're going to have a capital loss, which will either offset some or all of your income yield. Now, what we've done here is we've shown calendar year returns, so not rolling 12 months, but calendar year returns for the All Bond Index. This only shows you the income return contribution to that, so only one leg of that. And you can see how that income return has been increasing over the past few years. If we then overlay the capital return on top of that, so you can see income is still in blue, capital return has either been positive or negative, that's the gray bar every single year, and then the All Bond Index total return on black dots, you can see that over the past couple of years, what's really interesting is that the All Bond Index, despite all of this global volatility, we have had very decent returns from the Orbi over the past couple of years, kind of ranging from between 8.4 to 10%, with 2022 a little bit lower, closer to 5%. And this is despite the fact that every single year over the past couple of years, the capital contribution has been negative. So it really shows you the really powerful anchor that income is providing to bond returns. And if we were to talk about the poster child for a bond bear market, we don't have to look any further than the global bond yield sell-off in 2022. And let's just pause to think about what happened here. What we've shown on this chart is the Bloomberg Global Aggregate Index. So it's a broad universe of investment-grade global bonds. And this is the yield on that index over time. So if you go all the way back to 2007, global bond yields were trading between 4 to 5%. We then had the global financial crisis, interest rates were cut, central banks opened up their toolbox, they created all sorts of interesting ways to drive yields lower and lower and lower and flood the bond market with liquidity, culminating in the COVID crisis in 2020, where global bond yields were at their lowest level ever, and in fact were barely positive. There were quite a few bonds that were trading in negative territory at that time, right? So that was pretty unusual. And then what happened is very quickly after COVID, we had the surge in global inflation. Central bankers hiked interest rates aggressively in a short period of time, and bond yields normalized, not just back to where they were pre-COVID, but all the way back to where they were pre the global financial crisis. So very large rise in yield. We know now what that means is you're going to have a capital loss because yields rise, which you can offset against your income yield, but there was no income yield to offset against it. That was what was so unusual about this particular episode. And what did that look like in terms of total return? So we've shown the same index here, the Global Ag Index, and every single line here represents one calendar year in its history, from January to December, how the total return has revolved over the year. And what you can see in 2022, the red line at the bottom, is it's literally off the charts, minus 16%, eye-watering. And that's because you had a large rise in yield, so capital loss, no starting income yield to offset against it, and resulted in that. Now, the good news is that bond yields have risen globally. So if you were to invest money offshore now into the bond yield, bond market, you've got a much more attractive starting yield in your favor. The last lesson I'd like to briefly touch on is that not all bonds are created equal. And I know that sounds obvious, right? But we as fixed income managers, we often stand in these presentations. And thank you so much to BCI for always giving us, as fixed income managers, such great airplay at these events. But we talk about the bond market as if it's just one thing. A bond is a bond is a bond. All bonds are created equal. It's one homogeneous asset class. And obviously, that's not the case. So to illustrate that, what we've done is we've shown you the yield curve at the bottom, broken down. Your curve is time to maturity on the x-axis, so how long until your bond matures, and then yield on the y-axis. And you can segment the yield curve into different maturity buckets. So those bonds that mature up until 3 years form the 1 to 3 year or bond index bucket. Same for 3 to 7, 7 to 12, and bonds maturing 12 years or more into the future form part of the 12 plus bucket. Now, there are 20 odd bonds within the All Bond Index, and you can categorize each of them into one of these sectors, these maturity sectors. Having a look at the table at the top, we discussed how the Alby return over the past couple of years has been pretty decent. But interestingly, if you were to take the best performing maturity sector every year, which we've shown in green, if you'd invested in those sectors, you would have had high double-digit returns from your investment. But if you'd invested in the worst sector every year in red, you would have had very low single-digit returns. The differential in blue just shows you how starkly different that's been for some of the most recent years. And the reason for this is that different factors influence different parts of the yield curve, right? So if we're looking at very short-dated bonds, I've used here net bank factor analysis just to illustrate this point. If you're looking at SA 2-year bonds, they're driven by short-term global interest rate moves, but dominated by the SA interest rate cycle, which is the peach bar for the 2-year. Whereas if you were looking at a 30-year bond, it would be quite different, not really influenced by SA interest rates, which is the peach bar, but the light green, which is our debt to GDP. So South Africa's credit risk premium or fiscal risk premium is most important there. Now, in the interest of time, I just want to be very brief and run through 2 quick examples. First one was 2020, so when those differentials between the best and the worst sector were really wide, 2020 and 21. So I'm going to call out those 2 examples. In 2020, this was really the COVID epicenter year. So COVID struck, what happened? All around the world, central banks cut interest rates to emergency levels. South Africa was no different. What also happened at the same time, if you think in South Africa, we had a fiscal shock. So our fiscal revenues plummeted. Why? Well, the country was closed for a couple of months. But at the same time, our COVID-related expenditure increased. So there was a bit of a fiscal crisis. And what happened to the yield curve? We've shown the green dotted line is where it was at the beginning of the year, and the blue solid line where it was at the end of the year. Short-dated yields fell because interest rates were being cut. Longer-dated yields, because we are having this fiscal risk premium build-up, longer-dated yields moved higher. So if you were in the 3 to 7 year or the 1 to 3 year sector, you would have had fantastic returns that year, as much as 16% in the 3 to 7 year maturity sector, whereas if you'd held very long-dated bonds, you would have had a very anemic 4.6%. All bond index returned 8.7%. If we move to the following year, which is the COVID recovery year, All bond index, very similar return, 8.4%. But once again, where you chose your allocation was really important. So very short-dated yields underperformed because interest rates were starting to be thought about being normalized. So shorter-dated yields rose. The dotted line is where the yield curve was at the end of the year. But longer-dated yields were more behaved. They actually even rallied a little bit. So you had fantastic returns out of the long end of the curve and very suboptimal returns out of the short end. So the lesson that we learn from this is be intentional, choose your positioning across the yield curve very carefully, not just for where you think you are in the current cycle, but how you anticipate the coming cycle will unfold. In the interest of time, I'm going to stop there. Awesome. Thank you so much.
Awesome. Thank you. Thank you so much, Melanie. Great. Up next is JP. I think you can come through. And I guess maybe as you take your position, what is the one thing that's most underappreciated concerning fixed income? I mean, just looking back into the 25 plus years that you've managed money.
Thanks, Tavonga. Thanks, BCI, for the opportunity to present. I think the most underrated thing about fixed income, and maybe it's the reason why BCI gives us so much airtime, is that it forms the fundamental basis for most asset markets. We are the underlying sort of base curve, if you like, for markets, the risk-free rate, and a lot of liquidity that's put into markets and taken away from markets is done through fixed income. So I think that's an underappreciated part of fixed income.
Awesome.
Obviously, I enjoy fixed income. I've been doing it, as Tavonga very kindly mentions, for a very long time.
Thank you.
So I'm going to talk briefly about Methodical, a couple of slides, and I'm going to go into the topic. Methodical was launched in 2016. I joined in 2021 to launch the fixed income franchise. That franchise has grown from when I joined from about 600 million rand to about 2.5 billion. We run an income mandate, which is on the BCI Manco, as well as bond mandate. I have 12 years of experience in offshore markets. I lived in London for 12 years for my sins, and a long time in fixed income markets, both globally and locally. I came back in 2010 and then joined Prescient, where I was the deputy head of fixed income. So let's get into the topic. We don't have a lot of time today, so I'm going to try and 1985 was when Back to the Future was, just to make you feel old if you remember the movie. Are we in a new regime of monetary policy? Have we gone back to where we were before the global financial crisis? And what does that regime look like? And then ultimately, what does that mean for investors? How do we use that information? As a former colleague of mine used to say, what's the trade? So this is a chart that shows US inflation versus interest rates. What's interesting is how bad a job the US Fed has done. I mean, obviously it gets a lot of respect and it sits in a big building in Washington and gets lots of airtime and everybody pores over their statements and everybody, they're obviously an important institution. But if you look at their success rates prior to the global financial crisis, inflation was printing above 2%, 82% of the time. So it was below 2% only 18% of the time. That's not even a pass rate in South Africa. Between the crisis and sort of the end of the COVID period, inflation was above 2% only 37% of the time. So in these two kind of regimes, you had a period where the Fed was struggling to keep inflation down, or maybe just didn't try very hard. And then post-global financial crisis was struggling to get inflation above that 2% or at that 2% target. So where are we now? We've obviously been through a period of higher inflation. The Fed has put up interest rates, but we saw when the Fed put up interest rates, things started to creak. And then their financial stability mandate, which I think a few other speakers have mentioned, came into play with the failures of some of those smaller US banks. So they're treading a bit of a tight walk in terms of their monetary policy. And I will contend that we're likely to go back to the past, where inflation tended to print above the 2% target rather than below, and that rather this period after the global financial crisis was the exception rather than the rule. So what drove a lot of these factors, and why did we have this monetary policy exception? So one of the big drivers, I know a couple of speakers have talked about China, but one of the big drivers is that China influenced monetary policy, or influenced foreign exchange by keeping its currency depressed so that it could export goods to the US. And what that did is it brought disinflation, and it brought the cost of money much lower, okay? Because they weren't doing it on an economic basis. Well, they were doing it on an economic basis for themselves, but in terms of kind of US policy, you had this foreign buyer of your fixed income, and they were keeping those rates depressed. I know there's been a lot of talk about sort of geopolitical stuff, and I'm not going to get into it in any great detail, but one should remember that US now produces more oil than it uses. So its influence geopolitically is in a much different place than where it's been in the past. And that also means that a lot of the oil producers are sort of less required to park stuff in US dollars. This chart just shows monetary growth. It's a narrow monetary growth, but during COVID, no real surprise, the Fed introduced its bazooka and printed a lot of cash, and that cash obviously went into markets, went into inflation, and that's largely what drove that very high inflation numbers that we saw. Another thing we need to remember about the US is that it's running very large fiscal deficits. It's eye-watering amounts of fiscal deficits, and fiscal deficits need to be funded. And the way you fund fiscal deficits is you go out and issue treasuries. So there's a lot of treasuries that need to be issued, and bear that in mind when you think about where those long-term rates should be. It's going to be a fascinating election in November, but either way, it doesn't appear that the spending glut that we've seen from the US is going to stop. It's not going to stop unless somebody forces it to stop, i.e. somebody stops lending the money. Now the problem, the difference between the US and the UK, where we had the trust tantrum, as you'll remember, where bonds sold off because they didn't like the policies of Liz Truss. Unlike that, people are forced to put their money in the US because it's a deep, liquid market. There isn't really an alternative. So there's smaller alternatives like gold and Bitcoin and things like that. But in terms of deep, liquid markets, there's not a lot of other places you can put your money. This chart just shows you the soaring cost of US debt. At the moment, neither of the candidates seems to be particularly harping on about it because they know that it's a difficult issue to address. But at some point, you've got to stop spending money and borrowing money. When that day comes, I don't know, but it's going to put pressure. It's going to put pressure on interest rates. This is the U.S. Treasury curve going back in from 2019, just before the crisis, which is this lower curve, to where we are today, and that's been a 2% change in the overall long-term interest rates. Now I want you to remember that number because when I talk about the South African curve, the bond curve, you're going to just remember that 2% number. I'm not going to delve into this in too much detail. This is just from a piece of Avior research that I thought was interesting. I'm actually going to go to the next slide in the interest of time. But it just talks about different periods that we've had in South African history in terms of growth and what's likely to come. They call the sort of recent time failed state. I'm not sure I'd quite go that far. There's obviously been periods where we've had decent growth and then kind of periods where we had massive commodity cycles. So there's lots of different cycles. It's hard to know whether we're going to be in this period, depending on the election outcome, of sort of medium growth or whether we're going to be in this kind of, I hate to say the word again, failed state type of growth. But the market certainly seems to think that we're going to be in the more kind of demographic press, as they call it, which is just growth through the basis of increased number of people. South Africa has an administered pricing problem. What does that mean? What it means is that we don't have a demand-driven inflation crisis. Our inflation is not because everybody's going out and spending too much money. Our problem is because the basic infrastructure hasn't been looked after. This is not going to come as a surprise to anybody in the room, but that causes costs. So electricity is the obvious example. People have had to go out and put solar out or get generators or spend money on diesel, and that's been inflationary, and then they've had to pass that inflation on. If we get our act together, let's look on the bright side. If we get our act together and we can alleviate some of these administered prices, then we could be in a slightly lower interest rate environment. So this is just the South African interest rates versus inflation. You can see that over time, we've had interest rates above inflation or considerably above inflation. But there was a point between the global financial crisis and sort of the end of COVID where our interest rates were actually pretty low relative to inflation. Similar to what we had in the US, where they were struggling with disinflation, they were struggling with lower inflation, and they put interest rates incredibly low. We had interest rates in lockstep with that. And the point there is, going back to Tavonga's initial question, is that we move in line with those interest rates of the US, and we'll move again. So if we are entering a regime where interest rates are going to be higher, inflation is likely to print higher, then unfortunately, our interest rates, unfortunately for the economy, fortunately for income fund and bond fund investors, our interest rates are going to be higher. This is the same chart that I showed you earlier, the US curve and the South African curve. You can see that a large percentage of our move was actually driven by those US rates increasing. So we are very much affected by US rates. And here, if you look at this chart, you can see that our credit spreads in orange, South Africa, and this is emerging markets credit spreads in blue, don't really reflect the pessimism that we've heard in this room. The market's certainly not looking, as negatively on South Africa as maybe Sydney showed this chart, but we have seen foreigners leaving our market, selling our bonds. But part of that is driven by global interest rates. If US Treasuries are paying you 4.5%, then our bonds aren't as attractive because their bonds are higher. So we do live in this relative world. What will take this number going up again? I think we got to see lower rates in the US, and then obviously more certainty about what's going to happen in South Africa. So briefly, in conclusion, I think inflation may continue to be higher both in developed world markets like the US and in South Africa. Central banks don't want to burst your bubble here, but central banks don't always get it right. They might end up seeing inflation running hot for a long period of time. I know US Treasuries look attractive at 4.5 versus where they were 1.5 post-COVID, but if you kind of do it on a building block basis with inflation at 2.5 and real rates likely to be higher, it's not that compelling. South African bonds have high yields, but I think a lot of that's going to come from a lot of the returns are going to come from those yields rather than a large rally outside of a very positive maybe election outcome. But you don't have to do that because short-term interest rates are attractive versus inflation, so you can invest in that space. Thank you.
Thank you. Awesome, thank you. Brandon, I guess as you come up to position now, my question is, in the last 20 plus years, what is the one question that you wish the audience could ask you? Where do I sign to invest is Robert's answer.
That's a very good question. Firstly, I concur with whoever in the audience said that. Where do I invest? Or where do I download your application forms?
That was Robert.
That would also be a great question.
Cool.
I suppose in my mind, the question has often been, why is fixed income less appreciated? If we look at the kind of returns that we can deliver, certainly from active managers, they can compare with any volatile asset class. If you think about the various cycles that things have gone through, there have been stages where people have been advocating commodity funds and then tech funds and this and that. One of the most stable opportunities over all those periods has been fixed income. So I think fixed income returns, particularly geared fixed income returns, offers a very interesting proposition. And I think there's some very good fixed income hedge funds out there that would bear testimony to those kind of return expectations. All right, so I see my clock hasn't started yet. So
but you can,
am I to assume
you can start. I'll stop you.
Okay, thank you. Yeah, I'm here on behalf of Saffron Wealth. We've been around since 2012. It used to be a commodity hedge fund company. We bought in 2012, converted it to a fixed income long only and hedge fund company. And we've been operating out of Stellenbosch since then. That's our team. I suppose I should smile next time they take a photo, but everyone else seems to be smiling, so I'm encouraged by that. There we go. We specialize in quantitative, evidence-driven investment strategies across the whole spectrum of asset classes, including our Opportunity Income Fund, which has been around since 2008, our Active Bond Fund, which has won a Raging Bull both this year and 2 years prior, our Global Income Fund, which focuses on enhancing US dollar interest rates, our Qualified Hedge Fund, and of course our Flexible Equity Fund. We also run another hedge fund, which is the old-fashioned on-commodity partnership agreement, which last time I checked, I think over more than 10 years had done on aggregate, and you can call me a liar for a percent, more than 15% per year for something like 12, 13 years. So hedge funds can make you money in the right circumstances and with the right strategies. Okay, the majority of my discussion today is going to revolve around US rates. Why? Because US rates are really the epicenter of where fixed income takes its cue. If we look at US nominal rates in red there, you can see they've picked up very dramatically since 2021. And at risk of boring you with what everyone else has already told you, I'm just going to plow on here because I do realize I stand between you and your tea break. If we think about the 5-year break-even rates, those have actually come down quite nicely with inflation expectations. What this chart does tell you, however, is that the real driver behind not only our rates, but US rates, has actually been US real rates. And US real rates have climbed significantly over the last 2 years. Obviously, again, over the last 2 years, we've seen inflation come down nicely. And what that has done as well is not only make cost of living more palatable in the US, but it's also increased the real effective Fed funds rate, which you can see here as the dotted black line, up to this 2.5%. For the last year or so, we've been proponents of the view that moving forward from this point is going to become progressively more difficult, simply from a mathematical point of view, with inflation at those very high elevated levels. Lower inflation is almost a mathematical truism. In order for it to maintain those high levels, it has to continue to increase. A movement of prices, or prices moving in a flat direction, brings inflation down to zero as a consequence. We think here at this close on 2.5% real Federal Reserve lending rate, that is highly restrictive. And we do not foresee the Fed raising rates from this point onwards, despite what we're going to show you now. The problem with US inflation, however, is that the US CPI core and the PCE core, which is what we used to call cold and hungry inflation, so it's inflation excluding energy and housing, has been ticking up. And that has given rise to what we will talk about later on, if you can also just remember that slide. The US economy, though, has been performing really well, and this has been on the back of massively improved real earnings or real wages over time. And of course, the red line here being the US, I hope you guys can see it, has on average surprised more to the upside than any other economy. So what does this mean? This means that the US is obviously in a more solid position. It is more economically stable. It has a stronger pie, a larger pie to grow. But importantly, from a short-term liquidity point of view, the US is offering a risk premium far above its competitors. And by its competitors, I'll use the European Union as an example. So if we take the US 2-year rate versus the EU rate, the US rate is sitting just north of 2% above what you can earn in the Eurozone. What this has meant is, of course, that the US dollar, which to a large extent for many investors is also a carry currency. In many respects, when I think about the US, I think about a large economy that exhibits emerging market characteristics. And in many respects, the US dollar as a carry currency is similar to that. So with the strong carry motivation, you can see the correlation between the US dollar index and that carry rate. And you can see how that higher carry rate has benefited the US dollar quite significantly. Please bear in mind this last movement here, which is where the dollar weakened into 2024, because it'll tie into one of the slides later on. Now, what this chart shows you is the number of rate changes measured in 50 basis point increments that were priced into the US FRA curve over time. And you can see that in 2023, and in fact, just before 2024, up to 4 rate cuts were priced into the 21s, 24s FRA. And you can see that that cutting component there fits in exactly with the dollar weakness that we demonstrated in the previous chart. And as soon as the market decided that cuts were less likely because of stronger employment numbers and other such metrics, and the number of cuts diminished, we see how the US dollar strengthened again. And that is purely a carry argument. So we're talking about the US just like we would talk about South Africa from a carry point of view. Okay, some good news. Global PMIs seem to be bottoming out. US services PMI as well are healthy above 50, which means that from a rate point of view, from a Federal Reserve point of view, there's no great impetus to be raising rates anything beyond this. Now, looking at South Africa, and we use Brazil as a comparable, and looking at the SA 10-year nominal rate, you can see that South Africa has been on a steady deterioration over time. Brazil has had its own problems, political problems as well as energy-related problems, but for the first time in quite some time, barring that calamity in Brazil there, South Africa is trading above its peer group. And I think that's important as well, because South Africa is offering value relative to many of its peer group. I think what's holding back a lot of investors is the election, the imminent election, as well as rectifying some of the logistical problems that we have in the country, particularly Transnet, and of course the cash flows that inhibits, specifically for our miners. Are we for time? No, we're good. Okay, this is always one of my favorite charts, which is basically the 5-year CDS across multiple countries. And we can see where's South Africa. South Africa is there in line with BB-. Interestingly, Brazil, I think, is somewhere here. And what to me it shows is a massive opportunity for South Africa to clean up its act, have an improvement in its credit rating, and as a direct result, perhaps 50, maybe 70 basis points worth of cheaper borrowing can be achieved by doing that. Okay. Looking at our South African government bond curve, call it our bond curve, and I have used this chart many times in the past. What it is a factor analysis of kind of multiple factors on the different components of our yield curve. And Melanie spoke earlier about the differences between performance of a bond fund depending on where or which bucket you're investing in. This also tells us which bucket is driven by which factor. So in the 2-year bucket, I hope you can see that the rate is a major driver of our yield curve to the extent of about 67%. Whereas in the long-dated area, the 30-year area, you can see the repo rate is less consequential, but our government budget balance to GDP is important, as well as the US yields. Sorry, this thing is catching me here a bit. So the number that stands out here is this 0.74, which you see lines up with the US 10-year. That means that approximately 74% of all movements in our South African 10-year is determined by movements in the US curve. So that's why we spend an inordinate amount of time looking at what the US does, because the US rates drive South African rates. Tying it now also into our All-B returns, I've got 33 seconds left, so I'm going to wrap up quickly. If we take the All Bond Index, the individual bonds, and we stress test it by various interest rate levels, you can see that if the yield curve does not move at all, the All Bond Index generates about a 12.21% return. And again, sorry, Melanie, to keep using you as the example, but that comes back to the high income components of the All Bond Index. That is the income component of the All Bond Index. It is enormous. So basically, if nothing changes, you make 12.21%. If, however, with a, let's call it a favorable US backdrop, we do see some lowering in rates, which we can demonstrate has a direct knock-on from the US into South Africa, of say 1%, that lifts that All Bond Index total return to 18.58%. Interestingly, if you think about a 1% increase in rates, the All Bond Index will yield 6.42%, so not that far off cash. So this kind of asymmetry is one of the greatly neglected aspects of bond investing, which you'll all know as the concept of convexity. I won't go through that yet, but okay, so with all this in mind, how are we positioned? We're fortunate enough to manage both two onshore funds, an income fund and a heavy duration bond fund, or heavier duration bond fund, as well as a US dollar-denominated global enhanced income fund, which means that we're looking at all of the individual drivers in their totality. So our opportunity income fund right now, our opportunity income fund right now is heavily positioned in the less than 1 year, because what are we doing? We're trying to harvest those higher short-term rates at lower risk. And over the last couple of months, we've been slowly but surely accumulating longer duration. Our opportunity income fund, which typically has a duration of about between 0.25 and 0.5, now sits at a duration of 1.4. So many of our competitors will run heavier duration, probably around the 1.4, 1.6 level, but our active duration management shifts the duration of the fund fairly aggressively from, like I said, 0.25, which is 3-month risk, all the way up to 1.5-year risk in duration space. Our active bond fund, which has the All Bond Index as its benchmark, has spent most of its life at very, very low levels of All-B duration. In fact, our average All-B duration must be about somewhere between 50 and 60% of All-B, something like that. Nina will have to correct me on that number, but it is something like that. But in the recent past, we've been upping our duration. You can see there we have an appetite for the 1 to 3 year area, because we think we can catch the repo cycle, and in the 12+ bucket as well, because we think that part of the curve is where the compensation is maximized for each unit of time. In the dollar space, we've been very heavily invested in US Treasuries, 3-month Treasuries, 6-month Treasuries. We started nibbling into 2-year Treasuries fairly recently, and that's been because of our view on US rates.
Awesome. Thank you, Brendan. Thanks a lot. We're going to maybe head... So we've got another 10 minutes, so I think we can fairly cover quite a lot of things. I guess my first one, I think, to you, Sydney, is there were a lot of charts when credit rating downgrades was the only thing that dominated a lot of these fixed income presentations. And one of the most common things was that typically the bond market prices that in a couple of months ahead of the actual event, and by the time it's sort of confirmed, the bond market is probably already doing very well because it's way past that. Does the same apply with political risk, especially with the upcoming elections on the 29th? Is there a chance it's all already priced in? We really need to look 6 months ahead already?
Yeah, I think there's an element of both, Tavanga. What is really typical of our fixed income market or bond market is that it prices information in incredibly quickly.
Okay.
And as quickly as it prices it in, it moves on. Okay. So once again, as most of us have said, I'm not a political analyst.
Sure.
But we do view the elections as an event risk in the system. So being an event risk, you're most certainly going to see volatility, but the markets are quite resilient. The fixed income markets are quite resilient. I think we've already priced in a bit of that volatility ahead of time.
Sure.
And then secondly, what you will see, depending on what the outcome is or what actually happens on the day or two, you'll see a bit of volatility. That's going to be very natural. But I think we need to look through all of that. We need to look through the fact that the fundamentals haven't really changed. I think we, as JP said, now we're still governed by a lot of the factors that are happening globally, like global interest rates, global monetary policy, the US bond market, and then of course all our own woes that we are dealing with at the moment as well. We still, high employment is still there, there's still low business confidence, there's still problems with our rail infrastructure. Those things are the more fundamental issues that are being priced into our market. So the elections will come and the elections will go. I think if one has got the foresight to look through it and position yourself to look through the elections, you'll be able to be on the right side of things.
All right, well, thank you.
Thanks.
Milan, I'll come with you, to you as well, and maybe make you political analyst for a minute or so. So I understand that whoever wins the elections on the 29th has a maximum of 2 weeks to put a government together.
Yes.
2 weeks is a short time, meaning that they're probably already talking together. Do you think they're already discussing this and it's leaking into the bond market and it's all priced in?
Is it all priced in?
Because surely there is a few secret backdoor meetings already happening around coalitions.
Yes.
Maybe, maybe not.
It's a very interesting and quite a complex question to answer.
Sure, cool.
Firstly, is it priced in? I think some permutations are priced in, but I think it's more that, we've noticed the market's been trading with an additional risk premium of late. So there hasn't been, we've been moving with global events, and when Treasuries rally, we rally a little bit, but we've been leaving some of them move on the table because people are nervous to invest. And I think when I say people, I mean foreigners. So foreigners have been through many emerging market elections and they don't want to get caught short with this one. So if we are waiting for one of the catalysts for bond positive re-rating to come through from the foreigners, we have to wait for two things: the global cycle to turn and emerging markets to come back into favor, and for South Africa to be seen as investable within that asset class. And obviously we need a friendly, not friendly, but not a terrifying political outcome from the elections to achieve that. We're talking about, sorry, the second part of the question was?
There would be some secret meetings happening or
Secret
some
meetings.
negotiations.
Oh, yes.
Which
For our sins, we are so fortunate. As fixed income managers, we get all sorts of information. So we get to meet with political leaders. We had a Musi Mamani in our office the other day. We spent 2 hours picking his brain. We've had 20, 30 political calls in the last 3 weeks or so. I've got notes on every single one of them. We've got 3 this week. So I think we're very well informed on what's going on. But politics is quite different to economic factors. Everyone has an agenda. So you have to, everything that you get told, you have to filter through this lens. And I think it's undeniable that there could be conversations taking place behind the scenes. And why do I say that? If you look at how some of the political parties, their stances have evolved in recent months, you can see quite clearly they're pre-positioning for something. But no political party is going to say to you now that they're talking because they want the results first. They're not going to say that they're happy to lose. They're not. They're not going to admit that. They want the results first, and then the results will dictate who has the power and the bargaining chips, and that will then dictate the coalitions afterwards. So I do feel that there's a lot of uncertainty leading into it, and we have to think through it as analysts on a probability-weighted outcome. So if we think about all the different probabilities, depending on how much does the ANC get, there are 3 different scenarios, who do they have to do a coalition with, how much do they lose, and if you distill all of those scenarios, we've assigned a 9% weighting, probability-adjusted weighting, to that kind of doomsday coalition, which would be the ANC and the EFF. Why is that doomsday for us as bond investors? Because all those factors like Transnet and Eskom and energy security and growth would have question marks around that. That's a very low probability, but does have a very high impact if that were to come through. And I don't think that high impact is completely priced in. We will 100% have a knee-jerk reaction. We can look through that, but we have to be careful with our portfolio positioning going into that, depending on our mandate, to make sure that that type of outsized move doesn't significantly dent returns to intolerable levels.
Awesome. I think for Brandon as well as JP, I'm going to sort of make you political analyst as well. My biggest take from the presentation is that starting yields matter, and they look good, and you could lock those in and just go sleep and make a good return 10 years later. And but where I'm coming from is how, like, can it get worse? But from a political angle, and if I put a base case assumption that whether it is Joe Biden or Trump, they're all big spenders anyway, so they don't change the fiscal direction of the US, suggesting that it can't get worse than it already is. Or how would you tackle that, especially in the sense of then locking the,
Shall I take it?
Yeah, sure.
Yeah, so I think that's the interesting thing for me, and I talked about it a little bit in the presentation, is that the US is playing with fire in the way that it's conducting its fiscal policy. But the reality is that it is still the biggest, most liquid market. So it's hard for people to find other places to put their money. I guess it comes down to, the election result. I mean, Trump doesn't seem like the kind of guy that wants to stop spending. Biden doesn't particularly either, but, there is a fiscal conservative, kind of chorus in the US. They haven't had much of a voice because the US has been doing so well, and everybody's saying, don't take the punch bowl away and ruin this party. But at some point, that point's going to be raised. But it's exactly how it's raised and when it's raised, and it could be it's a massive issue for the global economy and global interest rates, because if we did have a trust tantrum in the US, which I'm sort of not predicting, but if it did happen, sure, it would be a massive economic and market impact from that. So it's very unclear exactly what path it's going to take, but the more they continue to spend and not face that fiscal, that's the fiscal trajectory, the more likely that it's going to be a very difficult outcome, if it does happen, if a fallout happens.
Can I just jump in there? So the market has a great way of enforcing that. It's a pity you've got to go through the pain to get to that. If you think of trust, that was pulled in very quickly by bond markets reacting to it. But you're right, the path to get there is quite an anxious
it's painful,
one.
potentially.
Yes.
All right.
Yeah, I think, and just on that score, I mean, you can think of other countries that have massive debt to GDP levels, such as Japan, but they're very unique. Japan has over 200%, I think, debt to GDP, but at the same time, that's public sector debt to GDP, but it has an offsetting private sector savings ratio. So I think...
and interest rates are so low.
And interest rates were so low, and inflation was so low.
Yes.
So I don't think the US is going to be as fortunate to have the same kind of prevailing economic circumstances whilst ramping up their debt to anywhere near kind of Japanese levels. Yeah.
Okay. And that would automatically mean that there would be a lot of upside pressure on our yields.
Exactly
by
right.
default.
So we will sustain that US, those higher US rates. I think what's of particular, I won't say concern to us, but certainly themes that we're going to be monitoring very closely over the next year are going to be terms of trade. That stronger dollar and... did it die again?
Sorry.
Am I back?
Yeah.
The stronger dollar obviously affects the terms of trade significantly, and that juxtaposed with the green spending as well as deglobalization, those are all going to be inflationary and are going to impact on the terms of trade. So I would be watching currencies and currency manipulation over the next year quite closely.
Okay, one last question. Eugene, I'll take 30 seconds if you don't mind. Cool, so essentially you have to give a word answer, unfortunately. I mean, your highest conviction idea for the next 3 years in the fixed income space, and then what are the chances your multi-asset income fund will outperform your bond fund in the next 3 years? High, low, so it's the idea, then high chance, low chance.
Yes. I'd say the multi-asset income space is a great space to be. Firstly, because...
High low.
You say again?
One
What
word
are the
answers.
chances your multi-asset income will outperform your bond fund?
Yes.
Just one word answer.
One word answer.
Yeah, high
On a
low.
risk-adjusted basis.
Yes.
Fairly good.
Okay, thank you. JP?
I'd say the bond fund would outperform. But that's just the way I run it. So, you know, it's more like an aggressive multi-asset income fund.
Thank you. Melanie, I know you love your strategic income fund very much,
Yes,
but
I
what are
do.
the odds?
I do definitely strategic income. I think initially, look, unfortunately, not unfortunately, we're moving into another cycle. So initially, multi-asset income funds will continue to do very well, but when the bond market does rally a little bit, anything with duration will do better, and that will be bond funds. But multi-asset income funds still have their place.
Also,
without a doubt.
lastly, Sydney.
I run both a bond fund and an income fund.
Yes.
So, yeah, right now I'm torn between the two, but I'll have to go with the income fund for as a high conviction. Yeah.
Okay, awesome. Thank you so much. Thanks, Eugene, for the extra
Thank
time.
you.
Thank you, everyone.
I think those answers at the end was valuable, and Melanie, very diplomatic answer. Thank you for that. Right. Tavunga, Sydney, Melanie, JP, Brandon, thank you so much. Just before we break for tea, very, very quickly, like last year, Dan Stillerman, I think Dan is going to come on now as well, from Excel Academy. He runs all the mechanics, the background for the online session, and he wants to share something again with the audience. So just give us 1 minute. Dan, are you there? Where's Dan?
Okay, I am here, Eugene. Thank you. I just want to make sure that everybody can see me and hear me in the room.
Got you. Got you, Dan. Perfect.
Okay, fantastic. Eugene, thank you. Very good morning to all our in-person and online attendees. My name is Dan, as Eugene said, and last year we ran a free Excel masterclass. And we've decided, because of the success of last year's event, we've decided to offer it to you again. So it'll be next Thursday, the 16th of May, from 10 to 11 South Africa time in the morning. And it's going to be live on Zoom, so you can tune in from wherever you are. And as always, it's going to be high energy, it's going to be interactive, and it's going to be very, very practical. We're going to be looking at an actual Excel download, and we're going to be working together to discover some secrets of Excel to work smarter, to be more efficient, to analyze your data and present your data. We also have our famous keyboard shortcut cheat sheet. We're going to give you a copy of this. It's got all of our favorite keyboard shortcuts, and it's very quick and easy to actually register for this. You just have to scan the QR code. I magically made it pop up here over my left shoulder, so you can scan that QR code. What I'll do as well is I'll pop the link to register in the Zoom chat, so that during the tea break, you can just click on that link and register. And I look forward to seeing you then.
Let's get going. Our next session on global equity, and here to moderate the session is Brendan de Jong from Portfolio Metrics. Brendan, thank you so much for joining us here today. It's really great to have you here. Joining him as well on the front is Andreas van der Horst from Mazi Asset Management, Adrian Clayton from North Star Asset Management, and all the way from London, Ben van Leeuwen from Lindsell Train. Gentlemen, thank you very much for being here with us today. Looking forward to your session on global equity. Andreas, if you're ready, you can actually start presenting and we can get going from there. Thank you.
Eugene, thank you very much for the introduction. Ladies and gentlemen, it's great to be here today. Let's get right into it. Performance is what matters. The Mazi team has delivered in chunks a meaningful performance after fees that you can have confidence in. We are enormously proud of our 1 and 2 year figures. We have delivered alpha of 7.1% over 1 year and 9.1% on a 2 year CAGR basis. On a 3 year basis, we are inching ahead. We've got confidence in our proven quality investment philosophy and process to outperform over the long term. Our fund is entirely invested offshore. Dollars paint the real picture of what's happening out there. The last 2 columns on the table present the dollar figures. Ultimately, we want to deliver real above benchmark hard currency returns to you. To sum up, We've delivered compelling global equity performance at a very attractive fee of 80 bips all in. How did we deliver this performance? Our performance is built on the foundation of our quality investment philosophy and repeatable process. We take 3 steps. We go out and search for the best companies in the world. To be clear, not fair companies at wonderful prices or speculating on tomorrow's next big thing. We're looking for companies that have already won and continue to win. Next, we buy these businesses at the right price. Valuation matters tremendously for generating exceptional long-term investment returns. And lastly, we let them compound. We are patient. Our portfolio turnover is very low, less than 10% a year. To quote the late Charlie Munger, the big money is not in the buying and selling, but in the waiting. Buy the best companies, buy them at the right price, let them compound. It's that simple, it's that hard. Let me explain why we follow this investment philosophy. We want to balance 2 central elements: deliver in hard currency and above benchmark performance over the medium to long term, and manage risk by avoiding the permanent loss of capital. So, what do we see as quality? If I can capture it in one concept, it's return on invested capital, or ROIC for short. Simply put, return on invested capital is the after-tax operating profit earned by a business against the amount of capital used to generate that profit. The question we are trying to answer is, how hard does the capital work in the business? How much after profit tax does each dollar of capital produce? The higher the number, the better. Why is this useful? ROIC is the one number that sums the total of all capital allocation decisions in the life of a business. You see, to us, this number provides a view into the heart and soul of the financial algorithm underlying the business. It is, in our view, the ultimate measure of intrinsic profitability. But ROIC is meaningless without context, which is why we compare it to the cost of that capital, or WACC, as they say. We look for businesses where there is a big positive gap between the ROIC and the WACC. That gap is the excess profit. The textbook name is economic value add, EVA. We want companies that produce lots of excess profits persistently. Plenty of companies do the opposite. They destroy shareholder capital. We want to avoid them. Next, we want a margin of safety. To us, this means competitive moats, high barriers to entry, ungeared bulletproof balance sheets, structural profitability through the income statement, and of course, we want to buy these businesses at an attractive valuation. But intrinsic profitability is not enough if you want to grow wealth in real terms above benchmark in dollars. You need secular growth, but not just any type of growth. You need the type of long-term growth that comes from the ongoing reinvestment of today's profits at higher returns on invested capital. It is this type of growth that over time multiplies the free cash flow attributable to shareholders. It is no surprise then that growing free cash flow drives the underlying compounding value of the business over time, leading to multi-bagger investor outcomes for the patient long-term investor. Lastly, we want to deal with honest, ethical, shareholder-focused people. Management holds the line between shareholder wealth creation and shareholder wealth destruction. Better to work with people that you can trust. Let me give you a picture of what I'm talking about when we speak of return on invested capital, weighted average cost of capital, and economic value add. Here's a picture of the index since 1995. If we look at the markets or global markets through the lens of return on invested capital, we can see that the median company earns a ROIC today of about 8.6%. This is the green line in the chart. This is what the companies earn on the capital in their businesses. The WACC is 9.1% today. That is the red line on the chart. This is what the capital costs. In good years, there's a positive gap. The companies are producing excess profit. Look at the gray bars. In bad years, our benchmark company destroys shareholder value. If you plot a cumulative figure for these excess profits over time, you will see the purple shaded area. Our benchmark company has delivered, give or take over 29 years, no more than 1.3% over the cost of its capital. Now, we've all been in the markets for some time. And if you consider the risk that you take in equities and the volatility that you have to stomach on a daily basis, earning an underlying 1.3% over time is a paltry result, you would agree. It's nothing to get excited about. So, what do we want to do? We want to own businesses that are substantially better than average. This is an example of a high ROIC business. This is the same picture, but for Meta Labs. Meta owns Facebook, WhatsApp, Instagram. It seems investors either hate or love this business. I can't count the number of discussions that I've been involved with where smart people have told me Facebook is going to zero. First, it was the Cambridge Analytica scandal. Then they were spending too much on the metaverse. Then online advertising apparently went ex-growth. Now they're spending too much on AI. But, as Warren Buffett said at this last weekend's Berkshire AGM, the market is there to serve you, not instruct you. The fiction cannot be further from the truth. This company is an excess profit machine. It has more than 3 billion users that it monetizes every single day. It has a track record of successful, profitable execution and growth. We've owned this business since day one. In the last year alone, the share is up 80%. The best years are still to come. This company is the undisputed king of capital allocation. It's an excess profit and share buyback machine. It's one of our largest holdings due to investment return, not position sizing. The company is called AutoZone. It offers repair services and sells aftermarket car parts. It follows the same formula in, day out. In the last 10 years, AutoZone has almost halved its share count. Over the same period, earnings and free cash per share are up 4 times. That's compounding free cash per share at 15% per annum in dollars. A very traditional company delivering exceptional investor returns. It's also useful to talk about businesses we don't want to own. It helps to focus the mind and ensure that we don't spend our time on businesses that are not good for us as shareholders. Let's talk anti-quality. We South Africans have a thing for mining. It's in our blood. But when the history of investment is written, mining will be the poster child of investor misery. For most time, resource companies have earned less on the capital invested in their businesses than the cost of that capital. Clearly, core business here is pouring money into a hole. I think the correct mining term is slope failure. As you can see from the picture, Glencore is a classic example of a business that is not good for shareholders. They are serial capital destroyers. When you put all the elements of our investment philosophy and repeatable process together, where do you end? The table on the left presents a scatter plot of the MSCSI ACWI. The vertical axis shows the median 5-year average revenue growth rate for the ACWI, which is about 10%, and the horizontal axis, the median return on invested capital over the last year, which is about 9%. Our portfolio is on the right. Our businesses have grown 50% faster, and they're almost 3 times as profitable. The underlying profitable compounding of our portfolio is simply better than the market. To finish off, we believe our quality approach will provide long-term investors with above benchmark performance in hard currency at much lower risk. Thank you.
Hopefully the mic's on. Good morning, ladies and gentlemen. Thank you, colleagues, for attending today. I'm representing North Star Asset Management, and I'm going to talk about flexibility in the markets that we have today. I'm going to start off with this quote from Swenson. Swenson ran the Yale Endowment Fund, $30 billion fund, 30 people, kind of the size of Coronation in South Africa with 30 people. And what he told us many years ago, he died in 2021, was that you need to be quite suspicious of your winners. And if you got a loser, you should be relatively hopeful. And that kind of, strangely enough, leads me into our next slide, which is a little bit around asset allocation. One you've seen so many times, but I'm going to make some highlighted points when we look at this slide. The first is that no asset class successfully produces the same return as it did the year before and ends up at the top of the slide. So, you know, an outperformer one year tends to be an underperformer the next. And then those that are the largest underperformers don't end up being consecutive underperformers the next year. That's one easy point to pick up. The next, of course, is that the underperformers, and if you look at 2017, very often become the outperformers of the following year. So US bonds, global bonds, US cash tended to be the best performing asset classes the subsequent year. If you look at REITs, you can see how they move from the lower bands right up to the top bands in the subsequent year. And lastly, US cash, which was a top performer in 2022, was an underperformer in 2023. Why are we telling you that? Because it's bloody hard to get asset allocation right. But it's equally difficult to get stock selection right, no matter what anyone tells you standing up here today. And Schloss is, if you don't know who that is, managed money for 45 years, regarded by Warren Buffett as one of the superheroes in this marketplace. He's actually a value investor. He compounded at 16% annualized against the S&P at 10. And he said something quite fascinating. We live in a society that changes, so you can't be too strict about the rules you applied in the past. Now, this was a stubborn guy. Buffett described him as stubborn. Yet he made the comment that you need to rethink the way you do things as time progresses. And that kind of leads me to the next slide. And hopefully they'll run them from the back. These slides demonstrate the changing capitalization of the top 10 stocks in the S&P over time. And you're not going to be able to follow them, but we'll talk to them just now. All right, stock persistency. Stock persistency is low, and I'll go into the details of that as we present the presentation. There were 33 companies, believe it or not, that you saw in that matrix. 33 companies that found themselves since 1973 to 2023 in the top 10 of the S&P. But what's interesting is 21 of those companies only made it into one decade. 13 made it into two, 8 into three, 3 stocks into 4 of those periods, 2 stocks into 5 decades, and only 1 stock made it all the way. And that's ExxonMobil, due to an acquisition. So what do I get out of that? If you bought the top 10 stocks in 1973, your top 10 portfolio would only have had 1 of them in 2023, which is an oil stock. The second point is that something's changing along the way. So in 1973, it was all about oil. In 1983, it was about industrials. In 1993, it was about consumer. In 2003, it was mixed sector leadership. In 2013, tech. In 2023, tech. And in 2024, tech. What's also interesting is why those stocks changed. And here's a little hint. I went back and looked at when they listed the stocks that represent the largest companies in the world now. Apple, Microsoft, Google, Amazon, Berkshire, Nvidia, United Health, J&J, ExxonMobil, and Visa. Believe it or not, 3 of them listed only in the 1980s, 2 of them in the 1990s, and 2 of them in the 2000s. So only 3 stocks, Berkshire, J&J, and ExxonMobil, would have been on your radar in 1973. The world changes, if we like it or not. So how do you deal with that? But before I get there, I thought this would be of interest. In 1973, I went back and looked at the headlines. The New York Times said on the 28th of October 1973, politically safe oil stocks win investors. Well, in 2024, not one of them was on the top 10. CNBC, 19th of February 2024, the so-called Magnificent Seven. The so-called Magnificent Seven now wields greater financial might than almost every other major country in the world. The question we should ask ourselves, will the Magnificent Seven still be there in 10, 20, and 30 years' time if persistency of history is anything to go by? So I'm going to get back to this slide. How do you solve the problem of what stocks to buy? And I'm not going to go into the detail of it, but I'm going to say a few quick things. We worked out, similar to the previous speaker, that returns on capital are important in companies. You give your assets to managers that give you high returns. So should we when we see companies. And we want the cash to come back to us as investors. So those are 2 things we look for. Quality businesses need to have cash, generative income statements, and they need to generate high returns when they invest. But if you add it to certain valuation criteria, what you tend to find is you buy quality companies when they're cheap, it outperforms the market over time. Over multiple periods, we've noted this to be the case. Not only does it outperform the market, but it caps your downside and increases your upside. So how does that look in terms of our own portfolios? So what we've done, and this is a complex slide, but I'm going to keep it very, very simple. On the left-hand side, you've got what's called NSGF. That's the North Star Global Flexible Fund. When someone fiddles on Excel, that's how they put it on there. And against that, you've got the MSCI All Country. And what we're trying to show is where our market, where we have exposure versus the market. So the far left-hand side, our fund has almost 15% exposure to very large companies. And then as we go further right, its exposure lifts in the mid area of the market. As against the index, it's heavily weighted towards larger businesses. If we look on the right-hand side, the Magnificent Seven in red, we've got very small exposures to the Magnificent Seven. In terms of the world's top 10 companies, we also have low exposure. But if you look far right, our total portfolio is represented only 16.9% in terms of market capitalization in the MSCI All Country. What we're telling you is we're buying the companies that are on their way to being super great, huge. We're not buying those big ones with relatively low persistency. Just in terms of asset classes and flexibility. So we've dealt with one thing, equity, the need to be flexible in terms of your equity exposure. The second is your asset class flexibility at this point in time. What we show here is if you went to bed in 1990 and only woke up in 2023, what would be the perfect portfolio to have owned? In the middle, we show the optimal portfolio would have had a standard deviation of about 11% and returned about 7% nominally an annum. Similar to equities. So if you mix asset classes cleverly, you get high returns and lower risk than the equity market. But we say that you should also take bets against that. So 2 points. One is you should know what the optimal portfolio is. 2, you should bet against it when the times are right. So what we show here is that optimal portfolio, what would it look like in terms of an asset mix? It's about 65% global equity, 15% bonds, a big chunk in gold, and some US cash and property, which has done very well, but at high standard deviation, high risk. Our work is to make sure that all our teams, of which there are 3 of them, fixed income team, local equities, global equities, do the work to give us an indication of what expected returns are going to come from those asset classes, and then to bet against a stale optimal portfolio. So if you look at that, we have hurdle rates and expected returns across all asset classes built from the bottom up, looking at every instrument that we analyze. This is a slide that's interesting, and it gives you some insight, because I've given a very high-level presentation today, some insight into the work we do. Our buy list has 100 stocks globally. Every single stock, we know what the intrinsic value upside is to our valuation daily. and we track that. If we can tell you what every stock is worth, what we think it's worth, and how much upside or downside there is, we should be able to tell you that for the whole buy list, which we track. So what we've done here is we've shown our buy list intrinsic value discount over time. And what you can see is when it's red, the market gives you no returns, or the buy list doesn't. When it's green, the returns are right up there, above 30%. So we bet aggressively when we're in the green space, and we bet against the market when we're in the red space. We do exactly the same thing for bonds. Some of our first slides, we showed you the bond market had a collapse in 2022. So obviously, the bond market pre that was overvalued. It had its collapse, global bonds started to offer real returns, and we started buying those, and you'll see that in the asset allocation in our fund. So that is the static portfolio on the left against our fund on the right, how it's positioned currently. And I'm just going to make 1 or 2 points. We're kind of neutral on equities because we're in the orange zone. Global bonds, we've been buying and selling because the market's been very volatile. It's made us a lot of money. We've been adding global bonds again now that yields have spiked higher. Cash has been a great place to invest because the yields have been there. And we had a big chunk of gold, which we've been reducing as gold prices rallied. Global property, we have felt, has been overvalued. So, putting all of that together, we demonstrated a problem. It's hard to beat the markets. You do it with tools. The tools are flexibility, structure, process in 2 areas: stock selection, asset allocation. And the proof's in the eating. We've been at North Star for 12 years. We've run a CIS offshore for about 8 years. And our goal in managing this fund was to outperform global equity managers with a flexible mandate. Now, naturally, we're operating 75% in equity. We don't have 100% exposure to the market like global managers do. And we clearly did that. And what we've shown on this slide, the orange bars represents our asset allocation and how active we are in tilting those asset mixes with the very tools I showed you in the first few slides. The red line is us, and the blue line are global managers. And what you can see is there have been 3 corrections in markets. The last one is the most interesting because bonds and equities collapsed together in 2022. And we generated, dropped by 22%, a large amount for our fund because we had some bond exposure, relative to the large managers down 28. But in the 2 corrections before that, we significantly outperformed that peer group. And we think that will continue to be the case. It's not every year you're going to have a bond correction. So even in a tough market, we still outperformed the peer group handsomely. And you can see how we've matched that peer group over time. So what do you get? Using flexibility, you get outsized returns, and we've managed to cap the downside when it counts. Thank you very much.
Hi, everyone. Thanks for coming. Yeah, we have come from London, and we've brought the weather with us, so apologies for that. Today, I'm going to be talking about this idea of dealing with uncertainty. So, of course, uncertainty is a timeless concept. As we all sit or stand here in May 2024, I've suggested a few factors I imagine we're all pretty uncertain about currently. The outcomes of various global conflicts, where inflation and rates will ultimately settle, and so on. What I am certain about is that this time next year, there'll be 5 new bullet points and many more besides. So the interesting question then becomes, how should one best react to these specific uncertainties, as well as uncertainty in general? So to us, the best answer has been and continues to be to try and do as little as possible. And we've stuck to that mantra with only 5 sales and 6 new buys over the last 13 years. That all adds up to about 5% portfolio turnover per annum, implying an average holding period of 20 years. Now, the reason we're able to maintain this incredibly low turnover, and more importantly, we feel confident in doing so, is that we seek to only invest in really high-quality companies. The kind of companies that can thrive across different cycles, different market regimes, and that therefore deserve to be held for these incredibly long periods. There's a number of proxies for this. We've gone with return on equity here, but the important thing is that it's a sustained and high return on equity. And as you can see, over the history of our strategy, the companies have, on average, succeeded in maintaining a return that's double that of the index. So here's why we think this continues to be the right approach, regardless of all of the various uncertainties we'll undoubtedly continue to face along the way. If you can find a great company that's able to maintain those supernormal returns and then hold on to it like a true business owner, then even if you pay what appears to be a high multiple, and even if that multiple regresses to the market mean over time, you should still theoretically outperform, thanks to the higher rates of internal compounding that you benefit from along the way. There's a small mathematical calculation to illustrate that. But to really bring it to life, I thought I'd give you a few more company-level examples to really demonstrate why we still have such ongoing conviction in our long-held names. The first reason is that our companies typically benefit from exceptionally durable demand. As you can see from this graph, Frito-Lay North America, which is the snacking business within PepsiCo, has now posted more than 60 years of consecutive sales growth. It has not had a down year. People cannot get enough of Cheetos and Doritos. Our companies also enjoy phenomenal pricing power. We have data going back to the early 20th century showing that Cadbury's has now raised the price of its dairy milk chocolate bar in excess of inflation for more than 100 years. And all the while, consumers continue to buy this company's products. The graph on the left shows the organic revenue growth breakdown for Mondelez, Cadbury's parent company. And as you can see, they've dramatically raised prices to deal with post-COVID inflation, and that's shown in light purple, and yet volumes remain positive in dark purple. And that is the beauty of investing in beloved consumer brands. But the strategy is a lot more than just consumer staples. We also love to invest in tech companies providing essential services that entire industries would not be able to do without. One example here is the FICO score, which underpins the US consumer credit industry. Regulators actually legally mandate it. Lenders build their systems on top of it. Investors use it to assess the risk of securitized products, and consumers even pay for it voluntarily out of pocket. It's an incredibly powerful ecosystem with, again, a multi-decade history for us to look back on and derive comfort from. Now, here's a factor that's actually giving us greater conviction over time, and that's how changes in distribution are making our company's revenues even more dependable and therefore more valuable. Our information services companies, like RELX or the London Stock Exchange Group, now make the vast majority of their money from selling mission-critical data under long-term recurring revenue contracts. And even our media companies, like Nintendo or Disney, which historically have been slightly more volatile investments, are now increasingly selling their content direct to consumers, also typically via these monthly recurring subscription models. But finally, perhaps the best defense against uncertainty is to invest in companies with really responsible leadership, who optimize for long-term prosperity and survival, and not to maximize short-term metrics and bonuses. And as a result, it's probably unsurprising that half of our holdings in the portfolio today still have some level of family ownership or involvement. It's not something we actively screen for, but it is the kind of self-selecting attributes that inevitably comes up when you're looking at companies with this incredible heritage that we look for. So those are some of the attributes that give us the conviction to largely maintain our holdings even in the face of ongoing uncertainties. However, our turnover is not zero. We do make adjustments. And I thought I'd walk you through the most recent one just to demonstrate what our thought processes do look like in those rare scenarios. So at the end of last year, we sold a company called Japan Exchange Group, or JPX, which we'd actually held since the inception of the strategy. And in its place, we bought a company called Universal Music Group, UMG, which is the world's largest music entertainment business. So to be clear, we still believe that JPX is an exceptional business. It has regulator-supported monopolistic positions across equity, derivative, and commodity trading in Japan, and is going absolutely nowhere. However, its fortunes are linked to the inherent cyclicality of the Japanese market. It's been reliant on inorganic growth historically, and we thought its options for new growth avenues were perhaps limited. And at the time of our exit, it was trading at a pretty elevated multiple, thanks to the current investor enthusiasm for Japan. At the same time, we saw in UMG an exceptional content owner with, crucially, a far superior recurring revenue mix, greater global growth prospects, and it was available at a much more attractive valuation. So hopefully that demonstrates that with every change to the portfolio, however occasional, we're always looking to upgrade the overall quality and resilience of the strategy, and that by maintaining a really high bar for these changes, we're also going to minimize the chances of unforced errors. And just to finish, here's one example of what can happen from maintaining long-term conviction, or to put it another way, successfully living with uncertainty day in, day out. So WWE, or World Wrestling Entertainment, which is actually now called TKO, has been a really noisy company to hold on to for the last decade plus. And that is partly captured in some of these extraordinary share price gyrations along the way, and in several cases, multi-year fallow periods. However, for those able to look past this fairly scary chart, they would have recognized the uniquely valuable nature of WWE's underlying content. It has all the best attributes of both live sports and scripted content. The flagship show is the longest-running soap opera in US history, and its content has been viewed more than 70 billion times on YouTube, which is the most global, transparent measure of interest. It's by focusing on the underlying factors like these that we're able to tolerate shorter-term disappointments along the way, and as a result, hopefully lock in the kind of longer-term outperformance that you can see there versus the MSCI. And that is exactly the approach we will continue to apply across the rest of the portfolio as well. Thanks very much.
Great. Thank you, guys. Really appreciate those presentations. We've banked some good time here for questions, and I'd just like to remind the audience that you're welcome to ask questions. There'll be a roaming mic, and then also for the online audience too. But first, Andreas, I'm going to start off on a headline level, and unfortunately, I don't even want to say the name, but Magnificent Seven has been something we've been hearing about a lot, and financial media has been really talking about the performance of these mega cap type of companies. But I understand you have a big data analytics engine powering your process, and you monitor effectively thousands of stocks, and the investment opportunity set for everybody here on stage is actually massive. So can you give us a bit of a feeling as to, under those big seven, has there been opportunity to outperform, or has it really just been all about big seven and then everything else has underperformed?
Yeah, it's a good question. I don't think anybody here manages a 3,000 stock portfolio. That's the business of ETF. So we're all in the work of dealing with concentrated portfolios when we doing global equity. So that's the first point I want to make. The second point, and I'll answer the question, I promise, is that if you're doing global work, you need to follow some kind of evidence-based, data-driven process to actually narrow down what it is that you are doing. And we narrow down on quality, and we want to find the best businesses that are growing and doing so persistently. So you need to build some tools to deal with that. But at the core of it, we're a fundamental shop. We find those companies, and then we research them, and we do a lot of work on them, and we travel, and we go see them. So that's the first point. It's important just to give that context. One of the things that sort of we keep track of is in the last year, the benchmark did 23.2% in dollars. That's now to the end of March. And over that same period, if, that's the Magnificent dominated. I think people say, like, if you weren't in the Magnificent Seven, you were not. But that's nonsense. Nobody's managing a 3,000 stock portfolio. There are 30% of the stocks in the benchmark that delivered in dollars over the last year, more than 23.2%. So you had, give or take, 1 in 3 odds of actually finding a stock that could have gotten you over the hurdle. And that's important to know. So people look into this thing and they see the Magnificent Seven dominating. It's not true. There are a lot of businesses, good businesses out there that you can find, you can own them for the long term, and they will help you get across the line. Our hit rate was substantially higher, which is why we outperformed the benchmark nicely over that period. And in terms of our portfolio, we only had 3 of the Magnificent Seven. We did not have Amazon, we did not have Apple, we did not have NVIDIA, and we did not have Amazon, Apple, NVIDIA, and we had Microsoft, Google, and
Tesla.
And we don't have Tesla, of course. Thanks for helping me out there. So, you can do the job without owning the Magnificent Seven, and you've got to really just find those businesses that meet the criteria of your investment philosophy and process that will get you over the line.
Thanks. Okay, Ben, this one's for you. So, even the greatest investors in the world they've underperformed the benchmark or the market at least on 33% of the time. Okay, so there are periods of underperformance, and a very, very important part of your strategy is holding period, buy, hold, and compound. Now, I've got no doubt that your investment team is capable of doing that, but how important is it for your investors to exercise that same kind of patience?
Yeah. It's a great question. It would be great if year in, year out, you could lock in that level of outperformance, but it's never that regular. That WWE chart shows how lumpy performance can be. That is a uniquely lumpy one. They're not all quite like that, but yeah, ideally you do want to communicate as best as possible to have at least that 5-year rolling commitment. It's just so unfortunate for people that can enter and exit at the wrong times and lock in something where if they had managed to wait it out and be patient, it would have been a very different story. I'm sure everyone's seen this, but there was a study looking at some of the best returns that the average US investor was able to manage. And there was one cohort that consistently outperformed everyone else. And I think it was Fidelity that did this. And it turns out it was people who'd sadly died. And they'd literally just left their allocations in place. They hadn't touched them. They hadn't made withdrawals. They hadn't touched. And that was the best way to lock in and avoid the whole behavioral aspect of getting freaked out. A media writes from you goes wrong, and it's a terrible year. And then the next year, it kind of triples. So yeah, communicating well. There is this element of self-selection. Just like companies come to Warren at Berkshire and want to sell to him, if you put your message out there and explain that you do have these incredibly long time horizons, the right kind of investor should hopefully find you and stay the course and hopefully lock in the outperformance that your companies are delivering. And it is there, but sometimes it isn't reflected in the short term. So as much communication as possible and getting the right investor base is key. Adrian,
so quality is definitely a theme on stage at the moment, and there's different kinds of definitions of that, and perhaps we can get into that. But I think the difference, and correct me if I'm wrong, and you're talking about flexibility, but then also that valuation overlay, and I'll give you guys opportunity because I don't think valuation's out the window for you either. But how important is that? And then from a turnover perspective within your portfolios, what does that look like? And I would like to move on to then Ben and Andreas. Is your kind of turnover stats in comparison?
Yeah, so thanks, Brendan. The story around quality, I think one has to define quality at any price as against at a reasonable price. And there are managers that are kind of more growthy in that space. We very clear that we want to buy businesses where we see discounts to intrinsic value, and we do a bear case, bull case, base case on every stock and a probability weighted return as well. And we have enough stocks under coverage that we don't have to own expensive businesses. And our experience with the work that we do on flexibility and the optimization we do is that it drives us in the right directions. And if we try and overguess it, we get it wrong. So the system and machine we built works. And it's driving us constantly to the areas of the market that are good businesses that are reasonably priced. In terms of how often we trade, we have an optimization meeting monthly where we look at reallocating assets, but it's marginal. To be quite frank, you're not seeing major changes in asset allocation on a monthly basis. We also have a weekly meeting, the global team, and we make small changes to the fund, probably about 30% turnover, but our persistency tends to be about 80%. So we hold from the day we started the fund to the day we're running the fund now. We still own 8 out of 10 of the same stocks, but we tend to turn them over. So we stay within our universe, we stay within our competency, and that has generated the returns that we've delivered.
Thanks. I suppose, Ben, I'll turn this to you, and then Andreas, you can also chime in here. But it's in terms of quality and the persistence of quality and what you kind of looking for. Why do you think it is that the market might systematically underappreciate high quality businesses? Because it seems that is ultimately what you guys are trying to extract.
That probably is the most important question of all. Yeah, we truly believe that there is a very, very small number of truly exceptional companies. And the reason the market kind of doesn't truly appreciate them is if you have a really conventional approach to WACC, for example, and you apply it indiscriminately across every company out there, we think that's wrong. Truly amazing companies, of which there probably are only 20 to 30, don't deserve to be put through the same cookie cutter approach as everyone else. And they probably do merit a really much lower discount rate. And that's fairly unconventional, and it's really hard to put into a formula and so on, which is why we like to kind of spin things around and actually look at what's being implied by the market. And if it's truly egregious, then obviously that is a red flag. But by and large, the work we do shows that, yeah, you can pay a hell of a lot higher for these companies. And there have been various studies. There was one fund that looked at the price you could have paid for L'Oreal, for example, back in 1970, and still locked in an 8% market return. And the answer was 270 times earnings. And that is not the kind of usual output you get from a conventional sell-side model where they don't want to kind of burn themselves too badly, they're looking 12 months out, and the margin of error is tiny. So yeah, we think there is a systematic mispricing for truly exceptional companies, which is why a lot more of our time is spent doing fundamental work, trying to make sure we have found them, than tweaking, the WACC by 3 basis points or something.
Andreas?
Yeah, I think, Ben, a good answer there. If I can just add, I think people battle with compounding. They battle to, we as people are wired to think in linear terms. And so we can see something sort of 1, 2, 3 years out, we can see the trend. But if the 1 is a 1 and the 2 becomes a 4 and the 3 becomes a 27, we don't see that. And that is also in a small subset of companies that are exceptionally profitable and also exceptional growers. They start to, in years 4, 5, 6, and 7, when everybody stopped caring, start growing those earnings and the cash at an underlying level at an accelerating rate. And what's the value of a company today? It's just the present value of all the unencumbered cash flows that belong to us as shareholders. So if any business is able to generate a lot of cash and reinvest it at the same level or better level of profitability, this cake starts doing this. And so we battle to see around the corner to see that. And so the market keeps on being surprised and keeps on adjusting its expectations. And this is what you see. There's this type of behavior in quality companies. And if you can find the quality companies that are growing quite quickly and, they've only done 10x, not 100x, then you start getting magnificent investment returns, and you start getting these long tail winners. And your job is to identify the long tail winners earlier on. So I think that's the core problem, time horizon and our inability to grasp what compounding truly means when it shows up in companies and in the generation of free cash.
I think I'm going to stick with you, Andreas, on this one, and it's AI related. But I mean, traditionally, these big tech companies, very capital light, huge margins and all this kind of stuff. But and I think the panel earlier was talking about the need for energy, and AI requires data centers and computing power, a lot of energy. And so you're seeing some of these companies actually investing in securing their own kinds of energy. I mean, how do you see that playing a role in terms of perhaps these businesses not becoming as capital light as what they are, and how do you see that perhaps affecting something like a return on invested capital in your process?
Well, certainly all the big tech companies, it's an arms race in terms of building out data centers. And you get data centers now today, which are literally AI training factories. The thing is the dark room, and it's kind of training data, and you get inference data centers, and they've got huge power demand. A business like Microsoft is interesting because for the majority of its life, it's spent about 5% of CapEx, 5% of sales on CapEx. That number has jumped to 15% because it is absolutely going crazy in terms of putting down data centers. But those data centers have genuine profitable use cases. So where we stand today now, Microsoft has, its return on invested capital has exceeded 30%, and it is going up. The results just came out, despite a massive CapEx splurge, and that's because we're all using Copilot, and we're using chatbots, and we're doing all kinds of things that these AI data centers enable. So I think there will be very, very clear winners that are able to pass the cost on. And you've got to always look at that cost, that is additional cost that is incurred, whether it's through CapEx or through the income statement, in terms of what is the productivity benefit that is coming from that. And businesses like Microsoft are producing enormous productivity benefits. So too Meta Labs, being able to more effectively place adverts, be able to integrate communities more effectively. So I think there are definitely going to be winners and losers. For our money, we're really in the business that either enable AI or benefit tremendously from it, or are completely immune to it. If you sell running shoes, AI is probably not going to change that very much. So that's kind of how we are positioned in terms of the whole AI theme.
Adrian, so flexibility, you got flexibility across asset classes as well, which is quite neat. And I found quite interesting is gold and strategic allocation. I think it was 13 or so, according to your optimal. But how do you value something that doesn't produce an income?
Yeah, it's very difficult. I mean, gold does have a history. And we value it. Mark does that. It's our income guy, and he's looking at money supply. And there's a relationship with gold price and money supply over time. So he tries to work back in terms of money supply growth, what kind of imputed price that would be for gold. We're not really buying it as a growth asset, to be quite frank. We buy it as it has one of the only areas where there's kind of a negative correlation with the rest of the market. So it definitely reduces drawdowns. I will say this much, we've had it for, I think, 2.5 years, and you can see we're paring back. I know everyone's talking about gold right now, but we've been cutting back our gold exposure because of the extent to which it's rallied, and because that money supply argument is running out a little bit at the moment. So,
cool. Yeah. Ben, we've got 1 minute.
All right.
Last question for you. So, and it's regional allocation. So a lot of talk about Magnificent Seven, but they're also US. So on a regional basis, the US has magnificently outperformed any other region for the last 15 years, actually. It's been relentless. So how do you look at that from your positioning? And then more specifically, London Stock Exchange is one of your biggest holdings within that. How does that kind of relate to it?
Yeah. So the London Stock Exchange, the name of the company is a bit of a misnomer these days. Only 5% of revenues actually come from direct equity listings in London. It is basically a data and analytics company. And that's a really interesting example, and it speaks to what you're talking about here. We put LSEG side by side with equivalent businesses in the US. And LSEG has Refinitiv, which is basically like a kind of Bloomberg-esque kind of data company. It has the FTSE Russell indices, which is a bit like MSCI or something like that. And we can also do this for RELX, which is our second largest holding, put that next to Verisk Analytics, another kind of US peer, and there are meaningful dislocations. So yes, it's unfortunate for people living in the UK, if you were investing in the entire index, that people are divesting, and it has been a fairly weak market. But for us, targeting 3 or 4 holdings within that UK market at a demonstrable discount, it's great because buybacks are much more accretive for us. We think we're getting US quality at a 30% discount, or it varies from company to company. And the more shares they can buy back at these prices, the better, and it can revert later. That's fine.
Thanks. We're done. Thank you.
Thanks, Brandon.
Thank you, gents. Brendan, Andreas, Adrian, and Ben, thank you very much for this session. We've got our next panel coming to the front already on global fixed income, being moderated by Michael Dott from Morningstar. And he will be joined by Paul Carr from 91 and Eva Sun Wai from M&G Investments, both our panelists all the way from the UK. So thank you very much for coming through. It's really great to have you here in SA. And Michael, thank you very much for moderating the session. I'll hand over to you. Thank you.
Is it me up straight away?
You want to start presenting right away? Yeah?
I'll do an intro quickly there, Paul. Okay. Come sit down first. No, thanks very much, Eugene, and thanks to BCI for having us and having the panel. And yeah, welcome to a panel on global fixed income. Yes, global fixed income. And I think to provide, it effectively provides some context as to how far global fixed income has come and how much the landscape has changed over the course of the last few years. And in sort of doing some research on what was said last year on the global fixed income panels, I went searching for the panels at the BCI Global Investment Conference, and there wasn't one. So I think it's good to use the conference itself as a bit of a momentum indicator that last year there were no global fixed income panels, and this year there are two. So on the current trajectory, I think we'll be headlining day one next year. But I think in all seriousness, we've seen the global fixed income landscape shift quite materially over the course of the last few years. Gone are the days of ultra-accommodative monetary policy and zero interest rates brought about by the COVID environment. And what's followed has been one of the most aggressive Fed interest rate hiking cycles in history, and that's dragged global bond yields higher with it. So yield is finally back on the table. To quote an FT article from last year, 2 years ago, to get a 5% return, you had to literally look to lend to the government of Iraq. Now you can get that on cash. So the era of TINA, the COVID era acronym that stood for There Is No Alternative, in reference to the choice between investing in equities and bonds, is over. And 2023, in more ways than one, brought about the era of Barbie, standing for bonds are really back in earnest. So to help me run through the asset class, I've got two London-based global fixed income managers, Paul Carr, who comes from 91, who co-manages the 91 Global Diversified Income Fund, and Eva Sun Wai from M&G Investments, who co-manages the M&G Global Bond Fund. So with that, I'm going to hand over to Paul. I think you're up first. Thank you. To run through the presentations. Thank you. Okay, thanks, Michael, and thanks for having me here today. Clearly, it sounds like there's been a lot of uncertainty given elections around this year in South Africa, clearly in the UK and the US. So let me give you all a bit of clarity on how we're thinking about the outlook for global interest rates across the world. But clearly, yeah, we are in a really interesting time at the moment. As Michael alluded to, we're back in the global financial crisis. Was the last time we saw interest rates this high. We've had a dearth of interest rates at 0% for nearly a decade and a half. But we can see interest rates coming back. And the question we get asked a lot of the time is, well, why aren't interest rates just going to fall back to zero again in global markets? And I think what's really important this time around, yes, we've got inflation, we've got uncertainty, but we're seeing central banks withdraw that liquidity through balance sheet reduction. So we've had years of quantitative easing, and that's reversing. And that really does change the outlook, I think, for interest rates more importantly going forward. It means liquidity is going to be tight, and we're going to move back to the old normal of interest rates before the global financial crisis. This is really important for investors, and it's worth taking some time to think about this, because while interest rates are back up at decent levels at 5%, you're also earning attractive income on credit-type investments in that portfolio. So your overall absolute yield in dollars from a global perspective is very attractive. It goes back to periods we haven't seen, as I mentioned, before the global financial crisis. Now, from an investor's perspective, in particular retail investor perspective, this top chart is really important because
you leave your cash in the bank account and you just do not get a return on that. And it's really important to actively switch that cash from your bank account into investments that offer the wholesale market return. And as retail investors, you can see leaving your cash overnight really doesn't give you much of a return. You can lock it up for a longer period, say 360 days, and you'll get a better return. But as wholesale investors like ourselves, we can go into that global fixed income market, in the US market in particular, and on overnight interest rates, on overnight cash that we have, we're earning that 5.3%. So automatically, as a retail investor, getting that lift from your bank account is really important and something you really need to focus on. So just taking a step back and how we think about global markets, clearly there's been a lot of discussion about higher rates for longer, in particular in US markets. Now, for us as global investors, what this chart really highlights for us is yes, interest rates, or certainly inflation, is coming down. But when you look across global markets, in particular UK, we think there's opportunities outside of the US core market to get that duration exposure in portfolios. So the diversity across global fixed income markets is very attractive from a global investor's perspective. And it really just highlights kind of our core view that we think UK interest rates will be falling faster, certainly from what we see in the US in particular. What are the reasons for this high core inflation in the US? We've spoken a lot about it, but I think this chart really highlights the key point to me when I look back at the data. And Christopher Waller, one of the FOMC members, highlighted this, this chart. And it's the number of the number of vacancies per unemployed worker in the US. And it's quite staggering, actually, that just after COVID, certainly in the peak back in 22, there were 2 vacancies for every unemployed worker in the US. And that's only now normalized back to 1.4 job vacancy per every unemployed worker. And to me, that really suggests that the US labor market remains extremely hot. And what does that mean? Well, there's a clear relationship with inflation and unemployment. And this chart really just highlights, when you have low levels of unemployment, which is on the x-axis at the bottom, it's not surprising you're seeing that sticky inflation in the US. Now, the FOMC members, or the US, the policymakers in the US, are really thinking that there's a lot more supply coming into the US through immigration and population growth. But my concern and our concern is that it's going to take a bigger shift higher in unemployment in the US, really to anchor the core inflation levels lower. So it really is a focus on a higher for longer scenario on interest rates in the US from our outlook. On top of that, a strong labor market brings the dynamic of wage gains domestically. Workers are able to negotiate higher wages in their pay packets on a monthly basis. And this chart really highlights what's happening in real wages. So wages adjusted for inflation in the US. And I think it's a key point. As inflation comes down and the tight labor markets are supporting those wage gains, and actually it's supporting growth, kind of at the worst time the FOMC or US policymakers really want that growth to be coming up. They want that growth to be cooling. But what we're seeing is actually growth is quite sticky and quite firm. Plus, as I said, elections are back on the agenda for this year. And as we know, it's quite interesting when you compare the United States on the bottom right-hand side with all the other developed markets. Actually, the US is running the biggest and the largest budget deficit. And that means also supportive growth going forward. And with the election coming up, there's more uncertainty, but the likelihood is that those budget deficits are going to stay wide and they're going to be supportive for growth as we move forward. At the beginning of the year, the market was really expecting this collapse of interest rates as we came through. So this is a chart of just interest rate expectations as we were at the beginning of the year. So January 24, as we came in, the market was expecting interest rates to decline. It's no surprising now that the decline in interest rates has been pared back significantly. And I think, and the reality is that you're likely to get through this year with maybe one, if none, rate cuts coming through for 2024. Oh, go back one. And when we think about this from an income perspective, there's a lot of discussion about spreads for credit, so for income being relatively tight, and that is the case. But that's, I think, reflecting the strong growth momentum that I've just been talking about. I think when you take a step back and look at the relative income on offer for US investment grade credit, which is the red line, relative to the dividend yield on equities, you haven't seen levels like this, as I've mentioned, for nearly a decade and a half, which is one of the core reasons why, yes, valuations are expensive, but we think from an absolute perspective, they're still a very attractive asset class. And that is really the core bedbone of the products that we run, in particular from a global perspective. Investment grade credit, high quality credit is the real backbone of that, because from an absolute perspective, it's looking even more attractive, and it's supported by the inflows that we see into the asset class as we go through the year. So finally, just thinking about how we position for this higher for longer narrative, we're very much focused on an attractive gross yield in the portfolio of over 6%, but that 6% income, which is really attractive, is actually undertaken with a very low risk in the portfolios that we run. Certainly a very conservative risk allocation in the portfolio. Duration relatively low, but as I mentioned earlier on, from a global perspective, there's many opportunities around the world outside of the US to have that duration exposure in your portfolio. And as I mentioned, a low volatility, but also an attractive investment grade rating on the products that we run. Thank you very much for your time today, indeed. Thank you.
Okay, great. Well, thank you very much for having us today. So my name's Eva, I'm a fund manager at M&G. I won't repeat the previous joke from the last panel that we brought the rain with us from London, but hopefully you get a bit better weather once we leave. Okay, perfect. So hopefully we're going to paint a bit more of a sunnier picture about why this is, as Paul said, a pretty good entry point, we think, for fixed income here. And if we look broadly at global markets and global fixed income, I agree, I think there is opportunities on a global set, and I think we're going from a phase of what I would consider more monetary policy convergence, with central banks doing very similar things. We had global hiking cycles really take hold over the end of 22 and the beginning of and throughout 2023. And we're now entering a new phase of divergence with differing economic backdrops, differing levels of inflation persistency, and this provides opportunities in global duration, in global fixed income. We know there will be some convergence in terms of central banks needing to cut interest rates from decade highs, but the problem is no one wants to go first. No one wants to front load the Fed for the risk of their currencies weakening versus the euro versus the dollar. We know that the SNB did go first, so we did have a cut from the central bank in Switzerland, but they had a very strong cushion in terms of a very strong currency. And so there's lots of debate about who will go first. It looks like the ECB have backed themselves into a bit of a corner in terms of a June cut. I think the Bank of England is the one central bank that could likely cut sooner than markets are pricing. It seems pretty wild to me. Perhaps we're biased because we're from the UK, but the fact that markets are pricing the Bank of England to be as hawkish as the Fed, when you consider the economic profile of the UK versus the US, that's the one that feels a little bit wrong to me in terms of market pricing. So if it's not the ECB, we'll likely see the Bank of England hiking prematurely to the Fed. But again, I don't think either of these central banks will want to be particularly aggressive, knowing that that will detriment both euro and sterling. As we know, Japan is the global anomaly. They have managed to hike rates for the first time in a long, long time. And I think they've done a pretty remarkable job at making what is actually a pretty pivotal and historic moment, ending a multiple decade-long regime of Abenomics into what markets have priced to be a pretty eventless outcome. So they've done a pretty remarkable job from that perspective. So how has this all transpired in markets? As we know, if we look at yields, so 10-year yield on the left-hand chart, we've seen lots of volatility. Markets are uncertain, but we are at a better entry point. I think whether we are entering a slowdown or whether we are entering a new regime with higher inflation, higher interest rates, higher R-star, higher ideas of neutrality, I think the outcome going forward is still rate cuts. The question is, are we cutting into a slowdown or are we going from very hawkish to slightly less hawkish central banks? The chart on the right is looking at curves, shows that yield curves are flat as pancakes. We still think the front end of curves is where we prefer to take our duration exposure. We do believe there needs to be more term premium priced into the long end, but we are becoming more constructive on the belly of curves as we have seen some steepening versus the massive inversion we saw last year. As always, Japan is the anomaly. We do have a steeper curve in Japan. We're broadly underweight JGBs given the rate differentials and the very low yields on offer from Japan, alongside a potentially more hawkish central bank, but we do believe there is a curve trade to be done at the long end, given the steepness and given quite perpetual stickiness you have at the long end because of regulation that requires pension funds, insurance companies to hold the long end to match their liabilities. So let's talk a little bit more about that entry point. This chart looks a little bit messy, but we'll talk through it. So if you ignore the yellow line for now, what we're doing with the green line is trying to map the 10-year forward rate in the US versus long-run FOMC expectations. Your red line is your median, your blue bars are essentially your upper bound and lower bound, so your most hawkish FOMC member versus your most dovish. Historically, when this green line has gone below the lower bound, that's been a good indication to sell duration, and when the green line has gone above the upper bound, that's been a good indication to buy duration. As you can see, in 2022, we had a big decoupling of the green line and the bars. For us, that was not the time to buy duration. In our view, it wasn't the green line that was wrong, it was the blue bars. So that was when central banks were still in team transitory, we weren't hiking, they were behind the curve in fighting inflation. Looking now, the decoupling is still there, but we've had a bigger adjustment in terms of the blue bars and FOMC expectations. That to us provides a better entry point. As Paul said, at the beginning of the year, markets were pricing in 7 cuts, therefore markets being more dovish than the Fed. That's a dangerous entry point when you then look at what's happened over the year when markets have now repriced according to US exceptionalism, according to a very strong economic backdrop. Looking now, markets are now pricing in a more hawkish outcome than the Fed. That gives you a much better cushion as an entry point into US duration. I'll quickly touch on the yellow line, which is just the equivalent swap rate, and whether that negative swap spread is indicating supply problems in the market, and that's what's being priced into physical bonds, or is it pricing in strong demand? And we've seen that before in swap markets, whereby in European government bonds, negative swap spreads have indicated high demand for bonds when there wasn't enough supply. So let's talk a little bit about that supply picture. We do think there needs to be more term premium priced into markets. We do think the fiscal outlook is pretty bleak in a lot of economies, especially in your periphery Europe, for example. But are we entering a fiscal crisis in the US? Probably not. And that's because if you look at what is actually making up that higher debt to GDP ratio in the US, only a small fraction of the debt, the red portion, is debt that was actually issued in your COVID, lower for longer, post-recession regime, where those interest rates were very low. So actually the majority of the debt that needs to be refinanced this year from the US is actually being refinanced from either the Bush era, a bit of Trump, and then other, whereby they actually issued at likely similar levels to today or actually higher. So yes, there is a supply problem. We do have fiscal worries, and we think that needs to be priced into curves. But actually the refinancing profile, we think, is not as bleak as markets often say. So I'll just quickly touch on why we also like inflation-linked bonds. A less liquid part of the market, but we do still think there is value there and they are attractive. This is looking at your inflation break-even, so your market expectations of inflation. I think they offer a very good cushion here. When you have high real yields, but low break-evens, that gives you a good entry point into taking duration through inflation-linked bonds. We've seen year to date that has been a good trade because they've broadly outperformed nominal bonds when you have those inflation expectations reprice and yields creep upwards. But actually on the other side, when yields are coming down, they're also outperforming. So they're also following the nominal bond, given they are still, at the end of the day, a bond. And so for us, inflation-linked bonds offer a good, diversified way to add to that duration exposure and give you a little bit of an inbuilt hedge as well. I'll quickly touch on credit, FX, and EM, but I'll do a whiz through. But given we do run very flexible funds, we can look at all of these asset classes within fixed income. In terms of credit, I think I'm actually a little bit more bearish than Paul. We do think that there is value from an all-in yield perspective, as you said, but we do think spreads are tight. I think there's a risk of too much complacency in markets. I think there's a risk of that US exceptionalism story really, taking hold in a way that I don't think you're being paid for, definitely in high yield, and you are being paid slightly in investment grade, but as you said, only in the more safe, non-cyclical, sort of sleep at night type credits. I think going forward, we're happy to clip the carry from certain sectors that we think will weather some sort of slowdown, whether that even just be a bit of stagnation as opposed to recession. But broadly, we don't think that you're massively being paid to take a lot of credit risk here. If you look at net interest margins, there is a fair bit of cushion from the big companies, especially from the tech companies. They're keeping those numbers looking reasonably stable. But actually, if you drill down into your SMEs, your more vulnerable parts of the market, we are seeing net interest margins start to be squeezed. On FX, this looks a little bit scary when I first put it up. This is what I have dubbed our currency snail. So it's a way that I like to rank currencies, and it's just showing a way that we can also add value within the portfolios using currencies as one of our many levers. What I will highlight here is essentially we're trying to rank currencies from your most expensive at the Mexican peso all the way around to your cheapest currency at the Turkish lira. A couple of things I'll highlight is that it's essentially showing you that even within regions, if you look at Mexico and then you look at Brazil at 5 past, even within regions, there's lots of divergence when it comes to valuation. Both of those currencies have returned you 20+% return in 2023, but we're seeing a very different valuation picture today. If I look at EM hard currency sovereign spreads, so another part of the market that we can access, not a lot of value here, to be honest, and again, a reason why we think developed market government bonds offer much more of an attractive entry point here. If you look at sovereign credit in emerging markets, on the left, investment grade, very tight, also considering a lot of those indices are comprised of Asia and the Middle East. So even with the geopolitical conflict in the Middle East, we're still seeing pretty poor valuations from a sovereign credit perspective. In high yield, there was some value around this time last year, but a lot of that weakness was being driven by single B and below. Local EM, however, is an area that we still like. You're still seeing reasonably elevated local yields, especially in real yields as well, so inflation adjusted. In many regions, you're still seeing high carry and low volatility. So there are many areas of local EM that we like, but again, divergence based on region. You have to understand the geopolitics, the local politics. You have to do your bottom-up homework. We have a brilliant emerging markets team that help us with that. But local real yields in EM, much more constructive on, and some of the higher yielders in Asia as well. We think there is value there. So the global set, definitely lots of opportunities and lots of reasons, I think, to be excited about fixed income here. And I'll just sum that all up in a lovely bow and link it to positioning, whereby you can see that we're pretty heavy on our developed market government bonds on the top left. IG, we still have some, but are de-risking as markets continue to be very strong. High yield, as I said, we're pretty bearish. We don't have any. And in emerging markets, low on hard currency, but still reasonably bullish on some areas of the local currency markets. Thank you.
Right. Thanks, Paul. Thanks, Ivo. Paul, I'm going to start with you. I think one of the prevailing narratives that we've heard, I think, across a lot of the panels over the course of the last 2 days, and it kind of came through in your presentation as well, is this narrative around interest rates that we're in a higher for longer environment. That seems to be the consensus view in markets at the moment. So how do you think about positioning your portfolios for that type of environment? And what are the risks around this outlook? Because we've seen in global fixed income markets over the last few years that the prevailing narratives can change quite quickly.
Yeah, sure. Thanks, Michael. And it's a very good question. I think from a portfolio and positioning perspective, I mean, I agree with Ava in terms of the high yield valuations. They really don't offer you an attractive proposition to own. So we're very much focused on that short-dated investment grade portion of the portfolio that really is the kind of your ability to, as Ava put it, sleep quite calmly at night and own the income on that portfolio. But clearly, the attractive levels of duration at the moment are really attractive. And if you do wake up in the morning and there's an issue, you get some protection with owning that duration within the portfolio. But ultimately, we're really focused on keeping duration short because we're just concerned, I think, as I mentioned, in terms of labor markets, the risks to higher for longer, and dare I say it, even the risk of a potential another hike from the Fed, which I think is quite a low probability. And we've recently heard from the Fed, and they really want to play down the ability of the Fed to hike again. But I don't think you can really dismiss it from this point onwards, given where inflation is in particular from a core perspective. So we're also focused on FX in our portfolio particularly, and long dollars is a nice defensive way of positioning and making your portfolio resilient for the higher for longer, and the risk also that you may have one more hike on the table, dare I say it.
Eva, I think when it comes to global fixed income, obviously there's a very large focus, understandably so, on what's happening in the US. But I mean, you've gone through in your presentation, painted quite a broad picture, and I think the world's a big place. So outside of the US, what is looking interesting to you in the global fixed income world at the moment?
Yeah, I think, as I said, local EM is an area that we really like, especially if you look at some areas of Latin America, again, with that high real yield and that high carry versus vol. Again, in Asia, some of the higher yielders, so your Indias, for example, especially they've got a lot of technical support with index inclusion, with foreign flows and that sort of thing. Indonesia, Philippines, those sort of higher yielders in Asia, where they also likely have room to hike rates higher. Those sorts of currency opportunities are also emerging as very interesting. I think a key area of markets in the global bond space is Japan, an area that we follow very heavily. It's one of our biggest underweights when it comes to duration. Naturally, obviously, the yield profile is pretty unattractive, and we actually have a central bank there that may actually be more hawkish than markets are pricing. We think there's opportunities in the currency that's very cheap, so the Japanese yen on a century-to-date basis is the cheapest it's been. We do think there are some potential catalysts that could push that to be stronger, but the biggest one will be external factors like the Fed cutting. But broadly, we do think that Japan is a very, very interesting place to look for a bond investor. And actually, if you are looking at global benchmarks, Japan is such a large part of a lot of your global benchmarks, when actually going into an active fund that has the ability to underweight an area like that is actually very powerful.
Yeah. Paul, I want to ask you about credit. And credit, as we saw from your positioning slide, it's a large part of your portfolio. It's one of the main levers that you're looking to pull. And we've spoken about, I guess, your slide showed the positioning of US investment grade credit relative to US equities as something that looks attractive on a risk-adjusted basis. But you've also spoken to the tightness of spreads, I think, at these levels. So I think in using credit as much as you do in your funds, I think, firstly, what is the types of companies that you're investing in? How do those look from a bottom-up perspective? And are you being compensated for taking on the credit risk that you're taking, given the tightness of those spreads, and particularly relative to government bonds, of which you own zero in your fund?
No, it's a good question. Look, I mean, we get asked daily, I think, about the relative valuation for investment grade credit. And I think while I agree that spreads are tight at the moment, I think what really gives us that support from owning the asset class, certainly investment grade, is that the fact that the growth scenario just looks so attractive at the moment. Growth remaining relatively high means that, an optimistic outlook, and it means corporate earnings and corporate profitability will remain relatively firm, and companies will be able to repay debt quite happily. And I think if that environment changes, we will be shifting our allocation. But it doesn't mean that in this current environment, there's going to be defaults. I think when we have come through this recent period since the global financial crisis with interest rates at zero, you've got used to an environment where companies have been kept alive purely because of free funding. Liquidity's been there on the table. And I think what we're seeing now very differently is that you are starting to see defaults in some of these companies. So what we really focus on, and we spend a lot of time focusing on in our portfolio, is ensuring diversification, but that bottom-up work that we do on the corporates mean that they're able to fund themselves and manage themselves in a higher for longer scenario. So we think with the focus for higher for longer, plus that growth outlook that looks really optimistic, if you have a diversified portfolio of investment grade, high quality credit in the portfolio, it still offers you an attractive income above cash. Clearly, we're focusing on a cash plus product, so we need to focus on some income above dollar cash. But I think at the moment, once you have that environment that looks optimistic, it's still a safe and attractive asset class to own in the portfolio. But you will get defaults coming forward in this cycle, so it's key that you focus on diversification and broadening the number of credits you have in the portfolio.
Eva, I think in a global fixed income context as well, and you showed a slide earlier that one of the key considerations you've got to think about in managing a global portfolio is the currency.
Yeah.
And the FX, and you had your ranking of where the various currencies kind of stack up, but obviously you're being measured depending on whether it's a hedged or unhedged share class in dollars. And we've lived through an era of prolonged dollar strength. But how do you think about managing currencies in your portfolio?
Yeah, I think there's multiple ways that you can use currencies within a fund like this to both add risk but also reduce risk. So actually, if you look at local currency bonds, for example, sometimes having that FX exposure embedded within it can actually be a bit of a natural hedge in a similar way, and then in a corporate bond you have the risk-free rate and the credit premium on top, and they often work against each other and give you a bit of a natural hedge. In a local currency bond, you have a similar effect whereby if you had higher yields detrimenting the bond part of that product, you would have likely a positive contribution coming from the currency in a higher yielding environment. So we can use currencies embedded in the bonds. We can also use things like FX forwards if we want to either hedge out exposure or add exposure purely from an FX perspective. So it's very flexible. And yeah, in the dollar, we're slightly more bearish. We think actually the dollar performs generally in a smile scenario, either when the world's going wrong or when the US is outperforming everybody else. And we think this is where we are at the moment, and we think that looks a little bit stretched.
So the screen is screaming at me to wrap up, but I think I can't leave without asking, particularly we're in a South African context, in a South African audience, and I think the consensus view we've heard from a lot of the fixed income panels, the local fixed income panels, is that South African bonds are currently extremely attractive with yields of around 11 to 12%. You obviously have a much broader opportunity set. So for both of you, very quickly, your views on South Africa as a fixed income opportunity versus what else you can invest in?
Yeah, I mean, I think for us, from a global perspective, yes, we want to access the high carry parts of the market, which South Africa definitely is. I would also argue, however, that it probably comes with a bit more volatility than some of the other contenders in similar regions. I think, I suspect we've been speaking a lot about election risks and what that means for pricing. I think it can be a little bit dangerous to trade on something as binary as an election. I think if the worst market unfriendly outcome is priced in, then that gives you some opportunities. But I think if the most market friendly outcome is priced in, then it's a pretty binary outcome with a risk to the downside if you're trading on that basis. So I think it's important to see how much risk premium you are being paid either in local bonds or in the South African rand according to your least market friendly scenario when it comes to elections.
Yeah, and I'll be honest, I'm not going to add anything that's significantly different to that view. We think the geopolitical premium, or certainly election premium, is priced into bonds. And if you can hold the volatility, the one thing that's clear on the outcome is that once the election's passed, you're going to get much more certainty. And with that, you get reduced volatility, and then the asset class becomes much more attractive again. So, again, we think it's just, if you can hold the volatility, you want to hold it, and it's one of those that will pay off in the long term.
Thanks very much.
Thank you.
I think we're out of time. I'm going to hand back to Eugene.
Thank you.
Many thanks, Michael, for good conversation, and thank you so much to Eva and Paul for coming all the way through to SA. Really great to have had you here. Our next panel are right and ready, last panel for the day. We're going to finish up on multi-asset, always a good session to finish up on. And here to moderate the session, from Brother Yates from Equilibrium. Flav, thank you very much for being here. Pallavi Ambikar from Coronation, thank you so much. Jonathan Meyerson from Visio Fund Management, and Richard Pitt from Blue Alpha. Thank you very much all for being here. Really great to have you here. Thanks, Phil. Over to you.
Thank you for joining us. I'm conscious that we are the last panel between you and something to eat, so I hope you'll find it interesting. I'm actually honoured to be on a panel with 3 managers that we use extensively in our portfolios. It's actually unusual. Often when you're moderating, you've got 1 or 2 of the panelists that are actually that we invest in. But this time around, we're lucky to have all 3 of you and veterans in the asset management industry. Before we start, I guess I'd like to ask the question. Multi-asset funds have had fairly moderate, in some instances, poor returns over the last sort of 5 to 7 years. So before I give you each an opportunity to present, I'd like to give you I'd ask each of you, I don't know who wants to go first, maybe you, Pallavi, since you're the only other lady on the panel, and we are coordinated in terms of our colours this morning. Do you believe that multi-asset funds will do better in the next 5 to 7 years than they have in the last? And if so, what would be the drivers of those returns?
Thanks, Lobela. It is a tricky question, just I think if you're anchoring off the past performance. I think what you have to bear in mind is starting points matter. So if you look from today onwards over a time horizon of 5 to 7 years, and as I'll touch on in my presentation, there's no doubt that we are looking at South African assets, broadly speaking, sitting at very cheap levels, whether we're looking at SA equity or SA bonds. And you would have heard that repeated throughout the presentations over today and yesterday. So from that point of view, your starting point is giving you a very large margin of safety and ability to deliver better returns. It's not a guarantee, but it is definitely a better starting point than I would argue you had 5 to 7 years ago. I think the second point is this big shift and allocation that we have now been allowed into the offshore asset space. And in that regard, maybe the starting point isn't as attractive as it was a year ago, given that we were coming off very low valuations in the global space. But I do think the growth opportunity set and the ability to diversify away from South African risks is very different today versus 5 to 7 years ago. So I think we have a broader opportunity set and a better starting point from an SA point of view.
Thank you. I don't know if either of you would like to add to that.
Yeah, I think I concur. The starting points do look quite appealing with yields at around 12% for bonds and maybe equity valuations not as stretched as they've been for some time. I think clearly the sources of return are going to be quite different over the next 5 years compared to the previous 5 years. Interest rates are higher. They're going to remain, well, don't know how high, but they'll probably on average be higher than they've been for the previous 5 years. And that just basically, in some ways, I actually think that for balance funds, it might be easier to meet the CPI plus 5 objective for the next 5 years than it's been for the previous 5 years. But nothing is certain.
Richard.
Well, I mean, those are both very good answers, but I think the truth is we know nothing about the future. So, I mean, to ask me my opinion about future returns is kind of nonsensical. What I do think is, certainly in our multi-asset products, we manage them based on strategic asset allocations. We take more short-term risk, for sure. Perhaps we have more volatility. But I think that is the way to get returns. You have to kind of, stretch yourself a little bit. So that's what we will continue to do, and we hope that will serve our investors well.
Thank you. And with that, can I hand over to you, Richard?
Yeah, thank you.
Thank you.
Right, good afternoon, everyone. So, spoiler alert, this is a multi-asset talk, but my talk has nothing to do with multi-assets. And that is obviously a conversation that Eugene and I must have. So one of the challenges, there are 2 challenges that I have every year. The first challenge is the Magnificent 7. Will they continue to be magnificent? And the second challenge is what I'm going to talk about at the BCI Global Conference. So my talk is value investing and the greater fool theory. And clearly this is slightly tongue-in-cheek, and I apologize. I have many friends who are present today who are value investors. They're great people and they're certainly not fools. But bear with me. So when we think about greater fool theory, and as I said, this has got nothing to do with multi-asset, but you can ask me questions about multi-asset. Here we just show the history of bubbles through time. We're familiar with these things. And I think what's interesting about it is I specifically cut this chart off in July last year. And if you'd looked at this at that point in time, you would have said the Bitcoin bubble had happened and was over. And perhaps you would have said AI was in the midst of a bubble. And AI is, the proxy for AI here is NVIDIA. Fast forward 10, 12 months, and we know Bitcoin had a huge follow-on bubble, if you will, and AI is still well and present. And so the tricky thing with bubbles is we can say you have huge price increases followed by price collapses, and there is a disconnect from valuation. But the key driver of bubbles is this notion of greater fool theory. And simply put, it speaks to the idea that people get involved in owning an asset class or investments simply because the price is going up. And the psychology of it, I think the poster child of this psychology of what Warren Buffett calls people seeing their neighbors who they think are dumber than them, making more money than them. Henry Blodgett, who you'll all remember, was the poster child of the internet. He worked for Merrill Lynch. And he publicly was, publishing these very high target prices for internet shares, and privately was saying, they were actually worthless. And yet he himself ended up losing roughly $1 million because he couldn't bear watching his friends and colleagues investing, in these stocks. So the obvious question is, what the hell does this have to do with value investing? And clearly that's a very valid point. Here I'm showing some data, which this idea sort of originated from some research that I saw by O'Shaughnessy and some colleagues. And basically what he was trying to do was he was trying to unpack the composition of returns of different factors, be they value, momentum, growth. And this chart is showing where the source of return is coming from in the value factor. And what we're talking about here is an index of 100 stocks equally weighted in the S&P 500 with the lowest forward PE, so the bottom quintile. And the blue bars refer to EPS growth. The gold bars refer to change in rating. And if you just have a cursory glance at it, you can see that change in rating appears, certainly for value, to be a bigger contributor. Now, in contrast, I know some people have gone on about quality investing, and I apologize, are quality investors, so I'll try not to bore you with our view on investing in quality stocks. But when you look at this universe and you take the top quintile with the highest return on invested capital, top 100 stocks, and unpack where their source of return is coming from, you'll see a far more dispersed picture. So, there's kind of like a spread of EPS growth and rating change. And if we add this together and make the comparison, so on the left, we have the value factor, and on the right, we have the quality factor, as measured by return on invested capital, you see a very, very different picture. And this was the thing that intrigued me. And of course, value investors will say, well, that's the whole point. You're buying these investments at a price cheaper than their intrinsic value. Now, intrinsic value is such a complicated topic, but it's much more than a 7-minute conversation. But the point is, intrinsic value sounds like an absolute, but it's not an absolute. It's an idea, and it's an idea based on forecasts about returns, about cash flow, about growth. So when I looked at this, I thought it was amazing that essentially all the return, as we measured in this analysis, in the value bucket has come from rating change. And implicitly, what that means is that you need someone to come along and buy that investment from you at a higher price. Now, that's a totally viable strategy, but it's quite different to comparing it to the quality bucket, which essentially the returns are coming from rating to some extent, and this could have something to do with the period that we analyze this over. but a lot of it's also coming from EPS growth. So it's coming from the underlying earnings growth within the business. Now, if we think simplistically about what drives winners and losers in the market, and we look at the extreme tails. So here we do a 10-year look back on the S&P 500, and we say, what is the performance of the top 20 stocks versus the bottom 20 stocks? And we show that in the bottom table, and you can see there's a huge divergence in return, massive. And then we say, okay, at the beginning of this 10-year period, what were the characteristics of these two buckets, be it on a PE basis, price to book, dividend yield? And the message is clearly that valuation doesn't help you in this regard. It's not the cheap stocks that give you the huge returns. The key difference, the key signifier is earnings growth. And you can see massive difference in trend growth in earnings between these two buckets. And that then informs our opinion as to how we go about looking for investments. So the idea is perhaps we should start with growth, and that's all fair and well, and yet we know intuitively that growth doesn't last forever. There's scale issues, there's competition. We observe it all the time, that growth tends to fade. And indeed, the study by McKinsey shows exactly that, where it compared the growth of, they looked at a universe of companies with turnover over $200 million, listed companies in the US, and then said over a 10-year period, what happened to their growth vector? And essentially, if you look at the bottom right-hand corner, you can see very few companies manage to sustain high rates of growth. Quality, on the other hand, and when we refer to quality, we're talking about return on invested capital, is a much stickier factor. Almost 50%, exactly the same study, looking at return on invested capital, managed to sustain high returns on invested capital 10 years later. So quality is a sticky factor, and there are many different research papers that refer to this, and I think some of the previous speakers have shown it. This is a different one, looks at it in a different way over a slightly longer time horizon on a rolling 3-year basis. And if I refer you to the top left-hand corner of this chart, it kind of tells the same message about the stickiness of quality, almost an identical number, like half the universe of high return businesses manage to stay high return businesses through time. So for us, quality is the key, and then we look at growth. And growth is important, but it has to come after quality. And the reason for that is that when your return, your base return on invested capital is low, the way you add value is you increase that return on capital. You create much more value by increasing your return on invested capital, like for like, than by just growing. And it's only when your return on invested capital gets to high levels, 20% plus, that growth actually adds more value. And I heard one of the previous speakers talk about this idea of earnings power and how it's quite hard to look, more than 2 or 3 years into the future. And this is just a kind of mental model, if you will, that we create. And we sort of imagine these different types of companies. So imagine a company that's got no growth and it has some cost inflation. And that let's call that the value trap. Clearly, a business like that, over 5 years, its earnings power is going to be destroyed. It'll just have no earnings. You get a kind of typical growth company in the middle. It grows at, say, 5%, but it has no operating leverage. It has no pricing power. So its gross margin can't expand, and its operating margins are consistent. So its growth is simply pegged to what it can deliver at the top line. And then a good company would have some operating leverage, and a great company would have pricing power. So you're getting some gross margin expansion. And of course, this is theoretical, but it highlights the idea over a 5 or 10-year view, just how vastly different the earnings power of different companies can be based on their kind of operating metrics. And then just to take this point a little bit further, it's like if you find a great business versus just a normal growth business, but not a particularly great business, what is the relative range that you can pay between these two businesses to get more or less the same return? And again, this is just maths. We just, we pick an exit multiple consistent for all the companies. and say, what is the relative starting point to get to the same return? And basically, a great business, you could probably pay as much as 3 times as much as kind of just a normal growth business. So it's worth bearing that in mind. And I think with really good companies, you need to try and push yourself to, to stay invested in them for the long term. The final point just about quality and value. We've had a lot of talk about interest rates. It's kind of died down, but certainly, the last 2 years, there was this idea of higher interest rates and the effect that they would have on growth stocks in terms of discounting future earnings. But I think we must also think about higher interest rates in terms of how it affects lower quality businesses. If your return on invested capital is just slightly ahead of the cost of capital, as the cost of capital rises, you actually, not in accounting terms, but in real economic terms, you start losing money. So I think a lot of cheap companies are often high-risk companies. And then my last slide, September will mark the 10-year anniversary of our global equity fund, the dark blue line on the top. And over that time, we've delivered returns in excess of the world index. And the gray line is the peer group average. You can see we are vastly ahead of that. The fund is number 1 in its category since inception. So I think it's just tests me to the fact that, we have an approach, we have an idea, and in fact, it has delivered good returns to investors over time. Thank you.
Thank you, Richard. Thank you. Jonathan will now take us through the Visio view.
Thanks very much. Good afternoon. Thanks for sticking around for the late session. I'm representing Visio. My day-to-day function is I head the fixed income effort, and I also oversee the asset allocation process, which obviously covers the balance fund. Really what we're looking at here, I mean, you've heard so many views and so many ideas over the last 2 days. I'll try and kind of pick what we think is particularly important when you put all these things together. And really what we do is we kind of take all the different disciplines and put them in one fund. And really we think that the benefits of a balanced fund is that you get diversification, you get flexibility, you need experience, and you need time. To meet the objective of CPI plus 5, which is generally the objective of South African balanced funds, you can't expect to get it over 6 to 12 months. The longer periods it will be required to go through the cycle. Just to give you an idea of the challenging times that we've been through, and when we chose to launch the fund, which was just under 5 years ago, we launched the fund in September 2019. 6 months later, COVID, the world looked totally different to what it looked in the previous 30 years. If you ever in investments say this time it's different, you might have a problem. But looking back for the last 2 years, this time has been different. And the question is how long it remains this different. I'm actually struck by the fact that, last year, I think if you had to do a word count of the word recession in the conference, I reckon it would have come up a lot. I haven't been to all the sessions. I've only heard a few. I don't think we've heard recession mentioned very often at all. And I think while it's certainly not our base case, there's certainly still indications there that we are very advanced in the economic growth cycle, and the risk of things going wrong is not zero. So in this environment, what we've experienced and what we're looking at here is the green line at the bottom is the average implied volatility of the S&P 500 over a long period of time. And since the launch of the fund, most of that period, volatility has actually been above that line. Yet, asset classes performed pretty well. The fund was able to reach its objective and really provide the kind of returns that we would have liked to provide. And I think the core reason for that is the ability to diversify. I think diversification has been said to be the only free lunch in economics. And I think that certainly works quite well. There's another free lunch in bonds, but I'm not going to go to the technical aspects of that. Looking at the experience, the team at Visio has got a lot of experience. in 27 years in equities. I've been in the market for 29 years. The offshore equity has been managed for 23 years, and we've got lots of experience in property as well. So experience is not everything, but it certainly helps. And the previous slide would have shown you that we have not had experiences like the inflation peak. I certainly wasn't in the market when we had that type of previous peak in inflation or spike in inflation. But it is important to have the type of experience and the diversification, not only, and I'll show you now, in assets, but also in qualifications. We've got engineers, we've got mathematicians, we've got an economist, we've got accountants, and I think together it helps and it's very, very useful to have those type of expertise in the team. In terms of geographical and asset class diversification, we cover 13 markets. We cover more than 13 indirectly, but we currently have exposure to 13 markets in the balance funds. We have sector exposure, which is wider than the fixed income. We manage, across the global opportunity set. We probably don't go down to the Latin America and sovereign, and there's good reason for that, but we certainly cover the main markets. Now, in terms of flexibility, what I'll show you here is just the asset allocation on the fund over the last almost 5 years, and you can see it's moved about quite a bit. And again, to the earlier comment around strategic asset allocation, that's the way we manage the fund as well. We sat before launching the fund, and we said, what mix of assets will give us a required return if things repeat themselves? Now, things repeat themselves over long cycles, but not over short cycles, and therefore we need to also have a tactical asset allocation. So we need to say, at times, we are in a point in the cycle where a certain asset class will do better than other, and that's where we make these changes. And that's the requirement of an experience and in-depth look into the different funds, asset classes. So I'm not going to go through. So on the right here, you can see what we call the strategic asset allocation. Domestic equities 45, and you can see. And just to the left of that, the current exposures. And I think outright, you can see that we prefer fixed income assets. It's not because I'm a fixed income person, it's because valuations suggest that. And we have preference for income right now over equity risk. And in particular, and I'll talk more into the decision to be overweight South African bonds over the South African equities and more underweight global equities versus the underweight in South African equities. And the point to the foreign equity point is really the growth cycle is mature, valuations are pretty tight or extended, and therefore we think mid-single digit returns is what you can expect and not much more than that, with scenarios around that. The global bonds we like holding for reasons that were mentioned earlier by one of the speakers at least, and the focus there has been more in the US market than other markets. There's certainly opportunities in the UK and in European bonds, but I think we're holding that. First, we like the yield. We like the fact that Barbie is in town and Tina's gone. I never thought I'd say that I like Barbie. But we like the fact that there's yield. And what we particularly like in the US Treasury, in the 10-year bond now with these kind of yields, is it does give you a bit of a hedge against things going wrong on the economic front. And that is always a good hedge for a slowing economic cycle. So the next few slides will be a quick discussion about domestic equities and domestic bonds. Very simply, one way of looking at the different relative value, it's a kind of a shortcut really, but just look at the 12-month rolling returns in South African equities versus developed market equities. We have not been this diverged, we have not seen this kind of divergence since 2002 really. And even if you believe in some sort of kind of reversion to mean, you would expect South African equities, I might need some water. You might expect South African equities to actually perform better than the global counterparts. And the same applies to emerging markets, obviously not as stark, but certainly something to consider. But there's some reason clearly why, and this is the reason why we're not overweight South African equities, is because with South African bond yields being so high, you can't expect valuations to be, similar to what they've been on average historically. Ps, when yields are at 12, should not be the same as when yields are at 5 or 7 or 8. And therefore, the argument is, well, you must be potentially, if they look relatively cheap, you might want to be long, particularly when inflation is coming down, and that red dots is the consensus forecast. And as a result, the repo rate will come down as well. And the red dots are, again, consensus forecast. The very small blue line is actually implied from the forward rate agreements in the market, which is expecting markets, the rates to stay unchanged. So what we did is we looked to see how the different asset classes perform after the last rate hike, and we do think that the next move is a rate cut. And you can see that historically, over the last 6 interest rate cycles, actually, in the first period, which is probably up to 20 months after the last rate hike, remember that was in May 2023, equities actually don't do particularly well. So we still prefer, and that's why I didn't make a point on that, but we are neutral property again, back to neutral. We overweight bonds, and inflation-linked bonds are a totally different story, which I'm not going to touch on now. And very interestingly, this is the average performance of the different asset classes over the last 6 cycles. And currently, we are exactly ranked in the same way since May 2023. So this current cycle is actually similar to previous ones, and in terms of magnitude, it might be different, but it certainly looks like it's following that pattern. So why we're not long on equities is basically because we do think that it's all about growth. And we just look here at South African growth versus global growth since 1994, since democracy. And you can see we've been slipping. The first decade equities did pretty similar to the world equity markets. In the 2004, 2013, things were looking good. The base rate for growth was quite high at 3.4, a bit lower than global, but still look at the great performance. And the last decade, so growth does matter. And I know a lot of equity people say, well, yes, maybe no, but it does matter. And I think over a long period of time, it's certainly something that we need to keep in mind. Now to my favorite point is on South African bonds where we are overweight. Now, we don't think they're cheap. I just want to make the point, and we think they're now offering value. And what we do here is we basically build the yield on a South African bond from the global risk-free rate, US Treasuries, South African sovereign spread, and the inflation differential. The big moves have been US Treasuries, we know, yields move from 1.5 to 4.5. The South African sovereign spread is another one which has widened quite a lot. And what we really look to do here is to say, we've got a red line, which is the fair value, and we've got a light blue line, which is the current yield. The current yield is higher, and it's been higher for a while. Now, we don't think it should come back to the red, but what we do here is we draw the current yield curve, which is showing you that on the 10-year point of the curve, you're getting a yield of about just over 12%. Now, in the event of nothing happening, you'll get that's your return. Nothing happening is very unlikely. And if you have half of that risk premium, the difference between the blue and the red coming down, or say in other words, returning to half where it's been over the last 5 years, you're getting returns that are basically a sum of your income return, 12%, this is the All Bond Index, and a capital return of 8.4. Now, in our modeling, when we look to see what we can expect from the different asset classes, we certainly don't expect the 8.4% in capital return from bonds, but we are happy with 12 plus returns on income. I'm not going to touch this, we haven't got time. So just to summarize, we certainly prefer income generating cycles at this point of the interest rate cycle, and we prefer domestic equities over global equities, yet we underweight on both. Thank you very much.
Thank you. Thank you.
Thank you, everyone. I'm very excited to be the closeout presentation for today. I will talk about the 4 key questions when we manage multi-asset class funds in today's environment. Just as a little bit of background, I manage the absolute return funds at Coronation, and so those would mainly be involved the low equity and medium equity multi-asset class funds. And the difference with these funds from a normal balanced mandate would be the fact that we have a dual mandate, a CPI +3 or CPI +4 return hurdle, but we also look at capital preservation and protection of capital because most of our clients are in the post-retirement space. So when we think about asset class selection and putting together portfolios, we're thinking about it through the lens of achieving CPI +3 or 4 returns, but also protection of capital. So risk is as important as return for us in the multi-asset class portfolio. So today's big calls in the multi-asset class space. 4 key questions. Firstly, how much of your portfolio should be in offshore assets? In the SA space, as I said earlier, starting valuations are looking extremely attractive. So from an SA asset allocation perspective, should SA government bonds be the anchor of your portfolio, or would you rather veer or pivot towards the very attractive risk-adjusted returns we think still available in SA equities? And then lastly, from an overall portfolio perspective, given that we are living in very uncertain times, in very volatile times, what tools are available for you as a portfolio manager to protect returns in your portfolios? So let's start with the first question. How much of your fund should you allocate into the offshore space? I think just a little step back and thinking about in the beginning of 2022, the increase in the offshore allowance for multi-asset class fund managers to 45% came at a very fortuitous time because it came at a time when global equities and global bonds started the significant derating. We took advantage of that investment opportunity and shifted our funds very quickly into the full offshore allocation allowed because we saw these very attractive investment opportunities, and that has come out, those returns and the re-rating that we've seen subsequently has benefited clients from that positioning. Today, we are still fully weighted towards offshore assets, and you could very good question to ask is why we are doing that given the re-rating. A few reasons. So let's start with global equity. Global equity has had a strong run over the last 18 months. And we still think it's appropriate to have a decent allocation to global equity because if you look overall, even though valuations are very expensive, specifically in the US market, regionally there are still global markets that are still attractively valued. So for example, the UK market trades on a 9 forward PE, the Chinese market on a 12 forward PE. So there are pockets of reasonable valuation in the global equity space. The second reason is that even in the US markets, if you take away the contribution from the large 7 to the US index returns, we think there's still a broad selection opportunity in global markets, and there are different drivers of returns that you can pick for your equity allocation. So as I'll show you later, we are seeing very good opportunities in not just in growth tech stocks, but as well quality consumer stocks and scale financial plays in the global equity space. All of these allocations have different drivers of returns and helps us build a more robust equity building block. And lastly, in the global space, if you put aside global equity, we think global corporate credit is also a very good space to be in. And we have built up our position in global corporate credit from a very small position 3 years ago to a substantial position today. And the opportunity really came about in late 2022 and into 2023 as we started seeing crisis events in global corporate credit that gave us the opportunity to pick up these credits with almost equity-like returns. And we think these allocation to corporate credit, despite credit spreads narrowing for South African investors, gives you a nice diversification away from what would otherwise have to be a very large allocation in the SA space to SA government bonds with all its attendant risks. So this really just shows you the the Coronation funds in the low, medium, and high equity space, and how we moved very quickly to full offshore versus a peer group that moved, I think, a little bit more tentatively. And the reason we could take such rapid and decisive action was we had invested a lot at Coronation in building up our global capabilities. So as a portfolio manager, we were very comfortable using an integrated approach in selecting assets both domestically and globally to derive the best returns for our clients. And we think that's quite an important factor in delivering superior returns for clients going forward. So let's shift back into SA and talk specifically about SA government bonds. We all know that the 10-year government bond giving us 12% plus, 6% real, is almost optically looks like a no-brainer. From a risk-adjusted perspective, you haven't seen these kind of real returns, barring a few huge sell-offs responding to crisis events. These are very good real returns, and for a portfolio focused on delivering real returns with very little risk, you would think that SA government bonds should be an anchor. Our view is slightly different. We are, from a risk perspective, think that the real returns on SA government bonds are on offer because of two very well-known risks. Firstly, the risk of rising deficits and increasing fiscal deficits. So here on the left, I've shown you SA government revenue and expenditure as a percentage of GDP, and you can see the widening jaws. And that's resulted to the graph on the right. If you see a continuation of these fiscal deficits, as well, and combine that with very slow and stagnant SA economic growth, what you're going to see is a rising debt to GDP profile. So our view is the dark blue line, a much more onerous debt burden for the SA government to contend with. And these two risks, I think, have been widely spoken about and are well anticipated by the SA fixed income market, and part of the reason why we have these very high real yields on offer. The one reason that isn't appreciated by the market, and probably not so widely discussed, is the risk of higher inflation in South Africa than we have seen in the past. And this comes about for a number of reasons. So firstly, we think global inflation will settle at much higher levels than it has in the past for very well-known reasons of deglobalization and the cost of energy transition. Those global inflationary pressures will feed into SA. And then looking at our SA profile, I think quite uniquely we have our own intrinsic inflationary pressures, namely higher electricity tariffs, higher municipality rates, so the administered prices that we have that feed into inflationary pressures, our wages that get set off backward-looking inflation, and therefore real wage increases continuing to play a factor. And then lastly, governments' method of dealing with this onerous debt to GDP burden, we think the most likely outcome will be some sort of financial repression. And that in and of itself will have its own extra inflationary pressures, and something we haven't seen over the last 5 to 10 years. So the risk of higher inflation makes us more cautious on SA government bonds despite the very attractive real yields on offer. So how do we deal with that and balance that risk versus the return that's still available to us? For us in our portfolios, we've tried to contain our portfolio's allocation to SA fixed income, specifically SA government bonds. Where we have an allocation to SA government bonds, we have contained the duration, so we haven't gone out very far on the curve in trying to chase very high returns. We have diversified into SA inflation-linked bonds. We have built up SA cash, also quite an unusual thing for us because we were finding very attractive opportunities in risk assets, but with 10% yields on 12-month NCDs, you are now getting very good returns on cash, and it's no longer a cash drag. So we have built up SA cash, and we have also used that global corporate credit bond exposure to act as a nice counterbalance to our SA fixed income exposure. So this really just leads me into this slide, a very nice snapshot of our global bond exposure. You can see a diverse holding across the range in these global corporate credits. No one counterparty stands out as a potential risk. And then we've also stepped into US government bonds. Once again, you know, the yields there now offering you a real return and an asset class we had avoided for many, many years, and also acting as a nice safe haven asset in the event of a big risk-off event. On SA equity, I think you've heard many presentations on how cheap SA equity looks overall. I think we would broadly agree the de-rating has been quite significant. But I do think you need to differentiate in the SA equity building block between the global rand hedge businesses that happen to be listed on the JSE, so the likes of Richemont, Naspers, Prosus, British American Tobacco. Those are global businesses with global drivers, and the de-rating of those businesses hasn't been as significant as the de-rating in the domestic SA-only facing businesses. And even though these domestic businesses have faced a very poor share price performance over the last 12 to 24 months, I think you still have to be very careful in selecting your entry points in this particular sector. It's not just a blanket buy because it's trading on a 5 or 6 PE and a 10, 12% dividend yield. We think you have to be very careful in the businesses you back in the SA domestic space. We are very focused on trying to pick businesses that can grow their top line despite a very stagnant economy. And those businesses are usually businesses that are gaining market share. And that is the only way we think, one of the only ways we think that SA companies can find growth in South Africa, because if the cake isn't growing, you have to back the person who's going to get the biggest slice. And that is the only type of business that can actually deliver good returns for your shareholders. So being careful in the SA equity space in terms of, especially in terms of our domestic equity selection. And then this slide, I think, is very important in this new Reg 28 world where we're allowed far more allocation in the offshore building blocks. We think it's important for multi-asset class fund managers to be properly integrated and think about the instrument selection and the asset allocation from a holistic point of view. So here what I've shown you is how our SA equity exposure and our global equity exposure marries at the top level of the portfolio into the different sector allocations. So as a portfolio manager, I want to see here a broad and a broad diverse sector allocation. It indicates to me that my portfolio will be robust in a range of economic outcomes or in a range of risk outcomes, and because the diversity allows different drivers of what will deliver my equity returns. And it also allows me to understand how much allocation I have to specific sectors, so that if any one sector suddenly becomes too big, I can adjust the portfolio positioning accordingly. And then the last question is how much protection is required in a portfolio. And that will depend on the risk mandate. We are more risk focused and more focused on capital preservation. So we are using a wide array of toolkits to try and preserve and protect capital. So firstly, and I hope it's come through in my discussion on the equities and the bonds, is diversity of selection, diversity of drivers of returns is your first level of protection. And then more explicit ways that we have taken protection is by buying put protection on global equity indexes. So we have bought about 30% of our global equity has put protection against it. We have built up our cash. As I mentioned earlier, now that it is giving us decent yields, cash has become an asset class that's actually enhancing our returns. And we have allocation to gold as well as US Treasuries, which are other safe haven assets. So we are using a variety of tools to try and preserve capital in the event of a risk-off scenario. This is how the fund is positioned today. We think that, as I said, quite a full offshore allocation is still appropriate. Balancing that with the income opportunities in both the SA fixed income and the global fixed income space. And if we think of the instrument selection as well as today's asset allocation and forecast our IRRs, for expected IRRs for these different asset classes, we're very comfortable that we can meet our CPI plus 4% target. This is for the Capital Plus Fund, given the selection we have today. Thank you.
Thank you. I see that I've got no questions from the audience, so I'm going to start with my questions. I'm going to start with you, Richard, since you spoke mainly through equities. We've had a huge amount of delistings over the last sort of 5 to 10 years in South Africa. Does the concentration in our market affect how you construct portfolios? And I know this is a multi-asset discussion, but specifically the SA equity component.
Well, it obviously makes it much more challenging. There are there's, particularly if you're trying to express a certain style, and in our case, as you know, we're a quality house, so we express that in our local equity holdings, and that is, that's very, very challenging in the South African context, and it's a function of liquidity and as you say, fewer counters. So yeah, it is a challenge. I think and much less of a challenge globally for us. The big thing for us really is we run at full offshore limits. So what we're always trying to do is, if we have a local South African equity position, make sure that that is not the same as a bet that we're making internationally. But yeah, I think it is challenging for sure.
And Pallavi, you spoke about using all the tools in your toolkit. I didn't see in any of the presentations any mention of unlisted assets. So in a low return environment, what do you think the role of unlisted assets is in a multi-asset portfolio, and how could you incorporate it? Obviously, there are limits in the Reg 28 context.
So it's going to be difficult for us to explicitly include that asset class in our funds, given that the mandate doesn't really allow for unlisted unless they have a pathway to listing, and I think that's within a 6-month time horizon. So it's a little bit more difficult for us to think about unlisted assets, but I would guess an investor in unlisted assets probably has a longer term time horizon than somebody particularly in our funds, and our post-retirement clients are looking for mainly income sources of funds, as well as looking to draw down on the funds to fund their lifestyle, their post-retirement lifestyle. So it's a different mandate, and I'm not entirely sure or convinced that unlisted assets would fit neatly into that space. Maybe with investors who have a much longer term time horizon, who are not as dependent on income, that would definitely be a lot more suitable. And then the second point is, in SA, I don't exactly see a really wide opportunity set of unlisted assets that are properly regulated, that have proper governance, and those are all other hurdles that you would need in the unlisted space.
Yeah, I agree with you. I actually think what we generally say to clients looking for alternative sources of alpha, we would try and include it in some of our portfolios, but with a much longer time horizon, obviously not in the Reg 28 space. And otherwise, how advisors could get their clients invested in then is to put the portion into normal Reg 28 portfolios, and then a smaller allocation to those unlisted. I've got a question for you, Johnny. I know that you've been cutting your ILB exposure. Now, with ILBs giving you about 5%, it's sort of screaming buy. And if we think that South African GDP growth could stay at 1% levels for the foreseeable future, even as long as the next 10 years, why are you not holding more inflation-linked bonds in your portfolio? So
5% is attractive, and that's the target, so we should buy and sit and be comfortable with that. But like we said, a 10-year maturity nominal bond is offering 12%, difference being 7%. So as long as inflation remains below 7, then we better off with a nominal bond. But what is more interesting is that that real value, that 5%, if we've got concerns about debt to GDP rising, which I share, but I think maybe the market is pricing some of that bad news, then the real component will rise on both nominal and inflation-linked bonds. The problem with the 10-year inflation-linked bond is it's got an interest rate risk almost double that of nominal bond. And that's why if you look back at the last 10 years, the only asset class in South Africa that maybe just gave you real returns is inflation-linked bonds. So it's actually not fitted the objective that it's supposed to fit. And I think that's something that one needs to be very kind of conscious of. There's, you were talking about liquidity in the equity market, and inflation-linked bonds have got low liquidity. There's no foreign participation, which on the face of it might appear as if it's a positive because they won't sell, but ultimately we need the interactions there to kind of, and ultimately they will meet their fair value. So Where we do have it in the fund is in the short end of the yield curve, where the duration or the interest rate risk is similar to that of nominal bonds, and what you get is the inflation carry, that pickup of every. So, for instance, why we're not selling the rest of what we're holding in May is because May on its own is going to give you 1%, which is much better than you'll get from cash, just from the inflation component and not even from the real. So, in these funds, generally, we need to be high conviction that inflation-linked bonds are better than nominal bonds. And when we do buy them, we generally buy them in the short end of the yield curve to give you that protection. You know, the Reserve Bank, but the Reserve Bank has come out and talking about lowering the inflation target. And therefore, I get comfort that nominal bonds are offering that kind of inflation risk premium that's required to do better than inflation-linked bonds.
Okay, that makes sense. And I guess issuance is also an issue in the lack of issuance. We've got about 2 minutes left, so final remarks. I know, Pallavi, you spoke a little bit about hedging in the portfolio, but given the increase that we now have in offshore allocation in multi-asset funds, and the fact that we have one of the most volatile asset classes, can you maybe just in one sentence wrap up where you would think use of hedging is appropriate?
So I thought you were going to ask me where the rand's going to go. But
if I thought you had a crystal ball, I would.
Yeah, let me talk to that from a protection point of view. I think we are very cognizant of the fact that we are positioned with the max offshore. So from our point of view, one of the shorter term risks is the rand and where the rand will go. And nobody can, you know, that's a mug's game. You can't call where the rand's going to go in a 3 or 6 month view. We have an internal view on what the fair value for the rand is, and that's sitting at around the 1850 level. If it's blowing out to extreme levels, and I'm talking about closer to 20, we will take protection. But where it is right now, we don't feel any particular need for any big protection on the currency. There is the 45% we have offshore, 5% of it is under currency protection. So I think you have to be more cognizant of your offshore allocation and how much currency protection you're going to take.
Right. Johnny?
Yeah, so we're at 35% offshore, and therefore we generally find that hedging the currency is not a good idea because it's actually a hedge and it allows for reducing volatility on the fund. When we get to extremes, then we will take positions, and the same, you know, on the underlying asset classes. Sometimes we will take derivative positions to hedge that.
And do you guys use hedging?
We certainly wouldn't trade the currency. On the pure equity funds, we do from time to time buy protection. It's an expensive business, and most of the time it doesn't work. But there are great benefits to it, which are mostly psychological. It allows you to stay invested, even though sometimes you think, you know, the market's run too far and it keeps on running. So, and if buying protection is cheap, then it's, you know, not a bad insurance to have. On the multi-asset side, we kind of see this offsetting hedge between risk and the exchange rate. So, you know, we have large offshore positions. When risk appetite declines, clearly those will go down. But typically what happens is the exchange rate then also blows out. So it kind of, you know, for us to overlay that with our clever ideas on top of that in terms of hedging the currency certainly wouldn't work. We're just not clever enough for that.
Thank you for that. We have run out of time, and I see there are still no questions from the audience. So thank you for your time. I think maybe just as a wrap up, I believe that multi-asset funds are still going to deliver. And I think if for no other reason, probably because investors are still not able to decide where they want to put their money. And unfortunately, with the volatility we've seen increasing in markets, having the ability to invest in other asset classes. Now, I would have loved to talk to you guys about tactical asset allocation and whether that adds value or not, but we have run out of time. Thank you, and thank you to BCI for giving us the opportunity to participate today.
Thank you, Florberta, Richard, Jonathan, and Pallavi. We really appreciate it in your time here today. Thanks for coming through. This brings us to the end of our session for the live venues. We will See you tomorrow morning at 9 online for the global or the offshore managers. Maybe just a quick word of thanks to all the fund managers that attended here today. Really big thank you. And our moderators for all the work you've done in your panel discussions. We really appreciate the time as well. Especially our international managers that flew out through to Cape Town for our session here the past 2 days. Really great. Thank you for that. Multimedia team, you've done great work. Thank you very much for your support. And the Tech Host team, Dan Stillerman. Dan, you online, you can't see me, but I can't see you, you can see me. Thank you so much for the work you've done for the online audience. Our online audience, again, we can't see you. I know you're all there, so thank you so much for attending. Last but not least, to Olga, the BCI team, thank you for setting up a session. And to you, our wonderful audience, that for your continued support, we remain extremely grateful for your support in making BCI a great success. And I see my boss is here. I don't know if he wants to chase me off or say something. Robert.
I just want to say thank you, Eugene.
Oh, right. Thanks, Robert. And we'll see you tomorrow morning at 9. Please enjoy lunch with us in the foyer. Thank you.